Hi friends, so let's cover the additional question, chapter 3, financial analysis and planning, which is basically ratio analysis. I think there are 4 questions in this area. Let's start with the first question. Following information and ratios are given for W Limited for the year ended 31st March 2022. Equity share capital 10 lakhs, reserves and surplus to shareholders fund 0.5, sales by shareholders fund 1.5, current ratio 2.5, debtors turnover ratio 6 times, stock velocity 2 months, GP ratio 20%, net working capital turnover ratio 2.5. You're required to compute shareholders fund, stock, debtors, current liability and cash balance. Go through this. Go through the question. Okay, few information is available in the question and we are required to compute totally 5 items. Shareholders fund basically means equity capital plus reserves and surplus. Shareholders fund is basically equity capital plus reserves and surplus are technically the net worth. So note 1, computation of shareholders fund. Note 1, computation of shareholders funds. Computation of shareholders funds. I have been given some information. Equity capital is 10 lakh. Reserves and surplus is 50% of shareholders fund. Reserves and surplus is 50% of 0.5. So we can say shareholders fund, right? Computation of shareholders fund. Shareholders fund split into two. Equity share capital, reserves and surplus. Equity share capital and reserves and surplus. Question has mentioned reserves and surplus to shareholders funds to be 0.5. So this is 0.5. Balance equity share capital is 0.5. Both are 0.5. 0.5 and 0.5. So your equity share capital is also 0.5 and reserves and surplus is also 0.5. Both are 0.5. 0.5 and 0.5. This number is 10 lakhs given in the problem. Equity share capital is 10 lakhs, which indirectly mean reserves and surplus is also going to be 10 lakh and shareholders funds is 20 lakh. The shareholders funds is 20 lakh because what is given is reserves and surplus to shareholders funds. The problem has given reserves and surplus to shareholders fund. So 10 lakh is the equity share capital, which is 0.5. Reserves and surplus is the balance 0.5, which should also be 10 lakh, and put together it is 20 lakh. Put together the number is 20 lakhs. This answers part 1 of the question, computation of shareholders fund. Next is stock, debtors, current liability and cash balance. Let us use this ratio. When you use sales to shareholders fund ratio, you will get to know the sales figure. You will get to know the sales figure. Note to computation of sales. Note to computation of sales. Computation of sales. Sales divided by shareholders fund is equal to 1.5. This will give us the sales figure. Sales by shareholders fund is 1.5. Sales by shareholders fund is 1.5. Sales divided by 20 lakhs is 1.5. The sales number is 20 lakh into 1.5. 30 lakhs. This will help us in getting some other information. Sales is 20 lakh into 1.5, 30 lakhs. Sales by shareholders fund 1.5 times. Sales by 20 lakhs is 1.5. Sales number is 20 lakh into 1.5, 30 lakhs. The sales quantum is 30 lakhs. Then using the sales and net working capital turnover, we will get net working capital. What is net working capital? Is current asset minus current liability, and current ratio is also there somewhere. This can help us in getting the current asset and current liability figure. It can help us in getting the current asset and the current liability figure. So I hope this is clear. Note 3, computation of net working capital. Computation of net working capital, or technically working capital. Technically working capital. Working capital turnover ratio. Any turnover ratio, sales or COGS divided by whatever we are using. So for working capital turnover ratio, we say sales by working capital. Sales by working capital. Sales by working capital. The ratio is 2.5. Sales is 30 lakhs. We divide that by working capital. 30 lakhs by working capital. 30 lakhs divided by 2.5. 30 lakhs divided by 2.5. 12 lakhs. The sales number is 12 lakh. 30 lakh divided by 2.5. The working capital number is 12 lakhs, which is current asset minus current liability. Somewhere this will help us in getting the current asset and current liability figure. Working capital turnover ratio, sales divided by working capital, 2.5. Working capital is your current asset minus current liability. We also have current ratio. This is a common adjustment in ratio analysis. They'll give you current ratio, they'll give you working capital. With that, we calculate both current asset and current liability. Note 4, computation of current asset and current liability. Computation of current asset and current liability. Current asset and current liability. Current ratio is equal to current asset by current liability. Current ratio is equal to current asset by current liability. The ratio given in the question is 2.5 times, is equal to CA by CL. CA is equal to 2.50 CL. Current assets is equal to 2.5 current liabilities. Current assets is equal to 2.5 current liabilities. Current assets is equal to 2.50 CL. Parallelly, I can say working capital is equal to current asset minus current liability. Working capital is equal to current assets minus current liability. The working capital figure was 12 lakhs. 12 lakh is equal to 2.50 CL minus CL. This is a common adjustment we do in ratio analysis. 12 lakhs is equal to 2.50 CL minus CL. 12 lakh equal to 1.50 CL. CL is equal to 12 lakh divided by 1.5. 8 lakhs. Current liability, current asset minus working capital is current asset minus current liability. Working capital is 12 lakh, which we computed sometime back. In that we set current asset is equal to 2.5 CL, 2.5 times current liability. So 2.50 CL minus CL. CL has turned out to be 8 lakhs. CL has turned out to be 8 lakhs. So CL is done, shareholders fund is done. CL is 8 lakhs. We'll also write CA. I'll need this later on. Current asset is 8 lakh into 2.5. 8 lakh into 2.5 into 2.5. 8 lakhs multiplied with 2.5. Current asset is 20 lakhs. The current asset figure is 20 lakhs. Current asset is 20 lakh. Current liabilities is 8 lakh. Okay, we are also required to calculate stock and debtors. Let's use debtors turnover ratio and stock velocity. Stock velocity is the stock days. Stock velocity is nothing but stock days. Next note, note 5, computation of debtors. Note 5, computation of debtors. Debtors turnover ratio is equal to sales by debtors. We normally say credit sales by average receivables. Average or closing is fine. Sales is assumed to be, or the entire sales is assumed to be credit sales. Debtors turnover ratio, sales by debtors, 6 equal to 30 lakh divided by debtors. Debtors number is 5 lakhs. 30 lakh divided by 6. Debtors number is 5 lakhs. Debtors number is 5 lakhs. The next note, computation of stock. Computation of stock. Computation of stock. Of stock. For that, stock turnover ratio, or technically stock velocity will be used. Stock velocity is inventory days, but I need COGS. I need COGS for stock calculation, because stock is based on COGS. Debtors was based on sales. So GP is equal to 20% of sales. GP is 20% of sales. COGS is 80% of sales. 80% of sales. Eighty percent of sales. 80% of sales. Stock equal to 80% of sales. Stock equal to you'll have to write along with me. In case I don't want you to write, I normally tell you to stop. So whatever I've been doing here, you'll have to write along with me only. stock is equal to COGS into inventory days. In this case, it's inventory months. So we'll call it as inventory month divided by 12. COGS into inventory month by 12. 24 lakhs into 2 by 12. 4 lakhs. 24 lakh into 2 by 12. So we are done with almost the question. Stock is done, debtors is done. Stock is 4 lakh. 24 lakh into 2 by 12 into 2 by 12. Last requirement of the question is to calculate cash, for which I've already calculated the current asset figure. Current asset is 20 lakh. Current asset is 20 lakhs. So we are required to compute cash. Next to note 7. Computation of cash, which is current asset is equal to inventory plus debtor plus cash. Inventory plus debtor plus cash. 20 lakhs is equal to 4 lakhs plus 5 lakhs plus cash. Cash is balancing figure. Cash is balancing figure. Current asset is inventory plus debtor plus cash. Cash is going to be balancing figure in the computation. 20 lakh is equal to 4 plus 5 plus cash. This was not a detailed balance sheet. Only few requirements were there in the problem. Complete this. Complete this part. Let's move to the next question then, which is on income statement as well as a balance sheet preparation. Looks to be a slightly detailed question. Following information of ASD Limited relate to the year ended 31st March 2022. Net profit is 8% of sales. Raw material consumed is 20% of COGS. Wages is 10%. Stock of raw material is 3 months usage. Stock of finished goods is 6% of COGS. GP is 15%. Debt collection period, that is debtor collection period, 2 months. Current ratio, fixed assets to current asset, fixed asset to sales, long-term loans to current liability, capital to reserves and surplus. P&L format and the balance sheet format is available. Go through this. The P&L and balance sheet format is there in the question. Okay, now these type of problems become simpler because the format is available. So we will put this format first. Working note 1 will be P&L, exact copy paste of the format. Working note 2 will be balance sheet, exact copy paste. So let's create the format and then we'll keep filling whatever we get. So working note 1, profit and loss, profit, and keep writing along with me, profit and loss account of ASD Limited for year ended 31st March 2022. Particulars amount, exactly what they have given, because we will not have any other item other than that, so it becomes kind of simpler. Particulars amount. It is technically a trading P&L, not only a P&L. It is a trading P&L because the format is given in that manner. To direct material consumed. We will try to find the figures later on. To direct wages. To works overhead. To gross profit total, to selling and distribution expense. Copy paste from the question, to selling and distribution, to net profit, again a total. In this side we have by sales total, by GP, by gross profit. None of the figures are given in the question, so we are technically required to identify everything. They have not given any figure in the problem. We have to find everything. Everything is blank here. Working note 2, quickly create the format first. Balance sheet of ASD Limited as on 31st March 2022. As on 31st March 2022. Liabilities amount, assets amount. Liabilities amount, assets amount. Share capital, reserves and surplus, long term loans, current liabilities. None of the figures are there. Good part is one figure is there in the asset side. Fixed assets 1 crore 30 lakhs. Fixed assets 1 crore 30. Current assets, stock of raw material, stock of FG, debtors, cash, and a total. So I'll wait for 1 or 2 minutes. Get the format ready. Get the format ready. Please get the format ready. Okay. Now there are multiple items. Net profit is 8% of sales. I can't do anything because I don't know the sales figure. Raw material consumed is CO. So all this can't be used. Only thing which I know as of now is the fixed asset figure, and using this I can get sales. Once sales is done, a lot of other things will automatically start coming in. So fixed assets to sales is there. I can use that. Once that is used, we will be able to get lot other information. So working note 1 or note 1, computation of sales. Note 1, computation of sales. Computation of sales. Computation of sales. Fixed assets divided by sales. Fixed assets to sales is 1 by 3. So 1 divided by 3. Fixed assets to sales is 1 divided by 3. Fixed asset figure is 1 crore 30 lakhs. 1 crore 30 lakhs by sales is equal to 1 by 3. Sales will turn out to be 3 crore 90 lakhs. This will help us in lot of data calculation. Sales is going to be 3 crore 90 lakhs. Fixed assets to sales is 1 by 3. So 1 crore 30 lakh by sales is 1 by 3. Sales is 3 crore 90 lakhs. So in the table, by sales in bracket note 1, 3 crore 90 lakhs. By sales note 1, 3 crore 90 lakhs. GP is 15%, NP is 8%. GP is 15%, NP is 8%. So gross profit 15% of 3 crore 90 lakhs. 15% and NP is 8%. Once we got sales, we are able to get a lot of data points now. 15% and 8%. Total will be 3 crore 90 lakhs. 15% and 8%. GP is brought down. This is balancing figure. GP is brought down and this number is balancing figure. We're just trying to complete as much as possible. 27 lakh 30,000. The P&L part is done. Trading account part, something is still pending. P&L part is almost done. Trading part, something is still pending. Okay, question also says your raw material and wages is something of COGS. So COGS is nothing but sales minus GP. So note 2, computation of COGS. Note 2, computation of COGS. COGS. COGS is equal to sales minus gross profit. Sales minus gross profit. 3 crore 90 lakhs minus the GP was some 15%. 58 lakh 50,000. 3 crore 90. 3 crore 31 lakh 50,000. Sales minus gross profit 3 crore 90 minus 58 lakh 50 minus 58 lakh 50, 3 crore 31 lakh 50,000. 3 crore 31 lakh 50,000. COGS number is 3 crore 31 lakh 50,000. And I'm going to use it here because question said direct material consumed is 20% of COGS. So 20% of 3 crore 31 lakh 50,000. 20% of COGS. 20% of COGS 66 lakh 30. 20% of COGS. Direct wages is, so we have captured this, we are now going to capture this. Direct wages is 10% of COGS. 10% of 3 crore 31 lakh 50,000. 10%. So P&L is over, almost over. This is balancing figure. Balancing figure. P&L is over 390 minus this and minus this. 2 crore 32 lakh 5,000 works over it. P&L part is over. We just calculated the sales and COGS. Everything else automatically came in. Everything else has automatically come in from the computation. Next, let's focus on balance sheet. I hope there are no doubts on P&L. In case there are, you can send it to me. P&L account is done. Let's come to the balance sheet part. In that, stock of raw material is 3 months usage. What is 3 months usage? Is 3 months of raw material consumed. 3 months usage is 3 months of raw material consumed. Your stock of raw material is on RM consumed. Stock of FG is normally on COP or COGS. You can take either of them. We normally take COGS also. Here they have said 6% of COGS. Stock of WIP is not there. So note 3, computation of stock of raw material. Computation of stock of raw material. Stock of raw material is equal to raw material consumed. Raw material consumed into 3 by 12. 3 by 12. Stock of raw material is equal to raw material consumed into 3 by 12. Raw material consumed was 66 lakh 30,000. Raw material consumed was 66 lakh 30,000 into 3 by 12 into 3 by 12. 16 lakh 57,500. Stock of raw material is 1657,500. Raw material consumed into 3 by 12. 1657,500. So note 3, stock of raw material 16,57,500. Stock of raw material 16,57,500. 16,57,500. Stock of FG is directly given 6% of COGS. COGS was some 3 crore 31 lakh 50,000. So 6% of 3 crore 31 lakh 50,000. 6% of 3 crore 31 lakh 50,000. 6% of COGS. Debt collection period is debtors. Debt collection period is debtors. All sales are on credit. Great. So note 4, computation of debtors. Computation of debtors. Note 4, computation of debtors. Debtors is equal to sales into sales into 2 by 12, 2 months. Sales into 2 by 12. Into 2 by 12. Into 2 by 12. 65 lakhs. 3 crore 90 into 2 by 12. Into 2 by 12. 65 lakhs. Debtors is 65 lakhs. Note 4. Debtors is 65 lakhs. Note 4. So we have used this. If I use fixed assets to current assets ratio, I will get to know the total current asset. Fixed assets to current assets ratio will give me the overall current asset. In that, I know raw material, FG and debt are cash is balancing figure. Cash is balancing figure. Note 5, computation of current assets. Note 5, computation of current assets. Computation of current assets. Fixed assets by current assets is equal to 13 by 11. Fixed assets to current assets is 13 by 11. 1 crore 30 lakhs divided by current assets. Current assets will be 1 crore 10 lakhs. Current asset is 1 crore 10 lakhs. Current asset is 1 crore 10 lakhs. Now cash can become a balancing figure. Current asset is 1 crore 10 lakhs. One crore 10 lakhs. So cash is 1 crore 10 lakhs minus other current assets. Minus all these items. 65 lakh, 1989, 1657, 500. And this completes the asset side of the balance sheet. Completes the asset side of the balance sheet. Asset side of the balance sheet is over. Asset side is completed. 2 crore 40 lakhs total. Asset side of the balance sheet is over. 2 crore 40 lakhs total. Now I will use current ratio. This will give me current liability. Then I'll use long-term loan to current liability. This will give me current liability. Current ratio will give me current liability. Using current liability, we can get long-term loan. Next to note, computation of current liability. Computation of current liability. Current ratio is equal to current assets by current liability. Current assets by current liability. 2 equal to 1 crore 10 lakhs by CL. CL is 55 lakhs. CL is 55 lakhs. Current liabilities 55 lakhs. Current liabilities 55 lakhs. This was through note 6. Note 6. Current liabilities 55 lakhs. Let's use the long-term loan to current liability ratio. That will give us long-term loan. Note 7. Computation of long-term loan. Computation of long-term loan. Long-term loan divided by current liability is equal to 2 by 1. LTL by 55 lakhs is equal to 2, and long-term loan is 1 crore 10 lakhs. 55 lakhs into 2. 55 lakhs into 2. Long-term loan is 1 crore 10 lakhs. The long-term loan figure is 1 crore 10 lakhs. The LTL figure is 1 crore 10 lakhs. Note 7. 1 crore 10 lakhs. Now leftover is share capital and reserves and surplus put together. We'll have to break it down, but if I just do a calculation, you don't write this. The gap is 75 lakhs. The gap is 75 lakhs. So share capital and reserves put together is 75. Share capital and reserves put together is 75 lakh, which is the gap. The gap is of 75 lakhs. Capital to reserves and surpluses 1:4. Capital to reserves and surpluses 1:4. Note 8. Computation of share capital and reserves. Share capital and reserves. Share capital and reserves. Share capital by reserves and surplus is equal to 1/4. So we can say 4 times of share capital is reserves and surplus. 4 times of share capital is reserves and surplus. 4 times of share capital is reserves and surplus. Is reserves and surplus. Apart from that, share capital plus reserves, the balancing figure, that is 2 crore 40 minus these two item. 2 crore 40 minus these two item, 75 lakhs. Share capital plus 4 times share capital. Share capital plus 4 times share capital is 75 lakhs. Share capital is 15 lakhs. Share capital plus 4 times of share capital is 75 lakh. Share capital is 15. Reserves is 4 times. 15 plus 60 lakh. 15 plus 60. 15 plus 60. This was note 8. 15 lakhs and 60 lakhs. The balance sheet is tallying. With this, I end second question. With this, we end the second problem. They have given a format, so it becomes simpler. When they give a format, it is going to become simpler for us to do. Let's come to question 3. From the following information and ratios, prepare the balance sheet as at 31st March 2022 and income statement for the year ended on that date for Messrs. Ganguly and Co. Some data point is there. Go through this. Go through the question. We are required to prepare an income statement as well as a balance sheet. So question has given average stock, current ratio, asset test ratio, which is quick ratio, PBIT to PBT, collection period, stock turnover, in which they are clearly saying use sales as the turnover. Stock turnover is normally COGS by stock, but here you'll have to use sales. Working capital turnover, fixed assets turnover, working capital, net profit margin, GP margin, operating expense, long-term loan interest, and tax. Tax is nil. Income statement as well as balance sheet. So let's put the format. Working note 1. Income statement. So we'll do it as statement rather than an account form. You can even do it in account form also, but we'll do it in statement. Income statement of Messrs. Ganguly and Co. Messrs. Ganguly and Co. for year ended 31st March 2022. Particulars and amount. Particulars and amount. Particulars and amount. Start with sales less COGS. This can give me gross profit. I may break down COGS further if needed. That I'll do it as a separate note. That is, you can break down the COGS as direct material, direct wages, other expenses, gross profit less operating expenses. We get PBIT. Why I'm differentiating? There's a ratio called PBIT to PBT. So PBIT less interest, PBT less tax, PAT. Tax is anyway nil, but let's write the format. And working note 2 is balance sheet. Balance sheet of Messrs. Ganguly and Co. as on 31st March 2022. At any place, in case you have to write something and I've proceeded to the next part, you pause the video, note the format, and then watch the video. At any time, anywhere, if speed becomes an issue, you just pause the video, note it, and then proceed. Liabilities amount, assets amount. We don't know what items will come, just the format alone. No, not writing any items and all. liabilities amount, assets amount. Sales less COGS, GP less operating expense, PBIT less interest, PBT less tax, PAT, and liabilities amount, assets amount. Okay, I have average stock. This is not closing stock, this is average stock, and I can assume this to be closing stock if I want. We have average stock, and along with average stock we have stock turnover ratio. We have stock turnover ratio where they have clearly mentioned use sales as turnover. So working note or note 1, computation of sales. Note 1, computation of sales. Stock turnover ratio is equal to sales by average stock. Stock turnover ratio is equal to sales divided by average stock. Sales by average stock 5 is equal to sales by 10 lakhs sales is equal to 50 lakhs. 5 is equal to sales by 10 lakh. Sales number is 50 lakhs. The sales number is 50 lakhs. Sales is 50 lakhs. Note 1. Sales number is 50 lakhs. We'll go item by item. Let's first try to complete the P&L part. I have the GP margin and NP margin. We have the GP margin and NP margin. So gross profit is 40% of sales. Gross profit is 40% of sales. COGS is balancing figure. Balancing figure. Operating expenses is given in the question 9 lakhs. Operating expense 9 lakh. PBIT is 11 lakhs. PBIT is 11 lakhs. PBIT is 11 lakhs. We have a ratio called PBIT to PBT. PBIT to profit before tax. PBIT to PBT. I'll use that and get the PBT number. Interest, they have given percentage. So amount is balancing figure. Based on amount and percentage, you can reverse work the borrowing. So how that happens, you'll understand. Note to computation of interest. Computation of interest. Computation of interest. Computation of interest. PBIT divided by PBT. PBIT divided by PBT is 2.2. 11 lakh. I have other approach to calculate PBT also. I'll explain. 11 lakh by PBT is 2.2. PBIT by PBT is 2.2. PBT is 11 lakh divided by 2.2. There is other way to get to this PBT number as well. 5 lakhs. So PBT is 5 lakhs. Interest balancing figure 6 lakh. no tax, profit is 5 lakhs. I could have also said PAT is equal to 10% net profit, 10% of sales. So we could have written 5 lakh and interest could have become balancing figure. We could have directly written PBT as 10% of sales. Anyway, tax is not there. PBT and PAT both are 10% of sales. This takes care of the income statement part. Now we'll try to get the balance sheet part. I have current ratio, I have working capital, common adjustment. Using both, you will get to know the total of current asset and current liability. Further breaking, we will see total of current asset and current liability. Will get overall current asset and overall current liability figure. So next note, computation of current asset and current liability. Note 3, computation of current asset and current liability. Computation of current asset and current liability. Current asset and current liability. Current ratio is equal to current asset by current liability. 3:1. Current assets is equal to 3 times of CL. 3 times of current liability. Current asset is 3 times of current liability. Working capital is equal to current asset minus current liability. Working capital is equal to current assets minus current liability. 10 lakhs 3 CL minus CL. 2 CL is equal to 10 lakhs. Current liability is 5 lakhs. Current asset is 3 times. We will try to break this further. So as of now, I'm not writing these two numbers in the balance sheet. Current liability is 5 lakh. Current assets is 3 times. Question has given average stock which can become closing stock, may not become. I don't know. I'll have to do calculation. 5 lakhs and 15 lakhs. Moment I use asset test ratio, you will get quick assets. Asset test ratio will give you quick assets, and quick assets is nothing but current asset minus inventory. Current asset minus inventory, somewhere we will get inventory which can be even equal to 10 lakhs. I don't know because they've used the word average stock, so I'm not writing that as inventory because I need closing stock. Next, note for computation of closing stock. Computation of closing stock. Closing stock. Asset test ratio is equal to quick assets by current liability. Asset test ratio is equal to quick assets by current liability. Quick assets by current liability. Current liability is 5 lakhs. Quick assets is 5 lakhs. Quick asset is 5 lakh. Quick asset is 5 lakh. What is quick asset is? Current asset minus inventory. Current asset minus inventory. So current asset minus inventory is equal to 5 lakhs. Current asset is 15 lakhs. Inventory is balancing figure 5 lakhs. 15 lakhs minus inventory 5 lakhs. Inventory is 10 lakhs. Inventory is 10 lakhs. I think the average stock is also the closing stock. Good. I could have directly also written, but we were not sure. Inventory is 10 lakhs. This was note 4. So here I'll write current assets. We may get breakup of this fully later on, but in that I know inventory. Note 4. Inventory figure is 10 lakhs. Inventory figure is 10 lakhs. Next is average collection period. That will give me debtors. Debtors. So next to note computation of debtors. Computation of debtors. Debtors is equal to sales into 30 by 360. Sales into 30 by 360, 30 days. Sales figure was 50 lakhs. 50 lakhs into 30 by 360 equal to 4,16,667. 416,667. Sales into 30 by 360. 4,16,667. $4,16,667. I have fixed asset turnover ratio. This can give me fixed asset figure. Fixed asset turnover ratio can give us the fixed asset figure. So next to note computation of fixed assets. Note 6. Computation of fixed asset. Fixed asset turnover ratio is equal to sales divided by fixed assets. Fixed asset turnover ratio is equal to sales by fixed assets 0.8, 50 lakhs by fixed assets. Fixed asset figure is should be 62,50,000. I think the asset side is almost over now. Fixed asset turnover ratio, sales by fixed asset. So fixed assets, we can have something as balancing figure if needed. I'm not sure if investments and all become balancing figure later on. And cash, 15 lakhs was the overall current asset minus other current assets. 15 lakh minus these two. This can become the total current assets in case I don't have investments. I'll see that later. We're almost done. I've used all the ratios, I think. Yeah, except for that long-term loan interest. How is that useful? We'll understand. Current liability, I cannot break this further. Current liability we had calculated earlier in note 3. Breakup of this is not possible. 5 lakhs. Current liability 5 lakhs. Long-term loan, we have paid an interest of 6 lakh. We have paid an interest of 6 lakh. That 6 lakh is basically 12% of loan. That 6 lakh is basically 12%. 6 lakh is 12%. 50 lakhs. And I think I'll keep it as shareholder fund balancing figure. I cannot break it further. We'll put a total. We'll put a total. I don't see any other item in the question. Let me just check it. Current ratio, assets, PBIT to PBT, average collection period, stock turnover, fixed asset turnover, working capital, net profit margin, GP margin, OPEX, long-term loan interest. So everything is considered. Let's put a total. So balancing figure is 22 lakh 50. If I want, I can just break it further, saying that this entire 5 lakh is reserves and surplus. That I don't want to do because there could be an opening reserves also. So I'll leave this as shareholders fund. I'll leave this as shareholders fund. Shareholders fund is 22 lakh 50,000. Balancing figure. Complete this. With this question gets over. Let's come to question 4. PI Limited has the following balance sheet as on March 31, 2020 and March 31, 2021. Balance sheet, shareholder fund, loan funds total, application, that is the asset side, fixed asset, cash and bank, receivables, inventory, other current asset, current liability is subtracted here itself, and total, income statement, sales, COGS, GP, selling, general and administrative expense, EBIT, interest expense, EBT, tax, PAT, inventory turnover ratio, financial leverage, return on capital employed. I'm going to directly write the formula and explain with the solution. I'm not going to solve it now. This is a very simple question. Go through the problem. I'll directly show the solution. Solving may not add much value in this question, so I'll directly show you the computation, explain the formula and then do the calculation. Three ratios have been asked. Three ratios need to be done. Go through the question. Okay, first is inventory turnover ratio. Because I have 2 years data, I'll try to use average inventory. COGS 738,500 divided by average inventory, which is average of these two numbers, 70,000 and 87,500 average. 70,000 and 87,500 average. 70,000, 87,500 average. 78,750. So 738,500, you need not write this, just understand the calculation. 9.38 times. They've just wanted for, if they had asked for both year, then average is not possible, because both year means for 2020 I cannot take the average stock. So we will do both years on closing stock only. Financial leverages, in your leverages chapter you would have learned EBIT divided by EBT minus that preference dividend, that is not there here. So 33,250 divided by 22,750. I'm quickly explaining it. No need to write this. 33,250, 22,750. 1.46 times. Then return on capital employed. Return on capital employed is ROI or ROCE. So return on capital employed, we have multiple formulae which is possible. The best formula is EBIT into 1 minus tax. EBIT into 1 minus tax, because they've said after tax, divided by average capital employed. 2 years average is there. EBIT is 33,250. Tax rate you will have to calculate using this. Tax rate you will have to calculate using this. 33,250 is the EBIT into 1 minus tax rate is 6825 on base of 22,750, just 30%. 30%. Average capital employed is share capital plus reserves and surplus, that is debt plus equity plus preference. Debt plus equity plus preference are fixed assets plus current assets minus current liability. So this is the capital employed, or you see the from the liability side. 210 plus 190 to find out average. 190 to find out average. 201 250 into 100 to express in percentage. 33 250 into 1 minus 0.3. Average capital employed 11.57%. With this, all your extra questions in this chapter gets over. All your extra questions in ratio analysis is over. Thank you, friends.
Okay, let's now start with the additional question of cost of capital chapter. We have question 1, which is on cost of convertible debentures as well as preference share. A company has issued 15% convertible debentures of 100 each at par with a maturity period of 6 years. On maturity, the debentures can be converted into 2 equity shares of the company. The risk-free rate is 10%, risk premium is 18%, beta is 1.25. The company has paid a dividend of 12.76 per share. 5 years ago, it paid a dividend of 10 per share. Flotation cost is 5% of issue amount. This is on convertible debenture. 5% preference share of 100 at a premium of 10%. These shares are redeemable after 10 years at par. Flotation cost is 6%. Assume a corporate tax rate of 40%. You are required to calculate convertible debentures using the approximation method, YTM method, to calculate the cost of preference. Go through the question. Go through the problem. Read through the question. Okay, there is a convertible debt part as well as the preference part. Convertible debt, they have asked us to follow approximation method. Convertible debt is basically same as your normal cost of debt, or technically the redeemable debt, which is interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. We use that formula and then get to the answer. Only thing is the redemption value will be higher of 2 numbers. It can be redeem as debt or it can be conversion into equity. So let's first do the cost of convertible debentures part. Let's start. Basic information. Basic information. We capture some 6-7 information. Point number 1, type of debt, where we write whether it's redeemable or irredeemable. So type of debt is redeemable / convertible. Type of debt redeemable / convertible. Life, it has another 6 years life. Coupon rate, that's basically the interest rate on the bond, 15%. Face value, ₹100. Tax rate, 40%. Net proceeds is what we collect today. Issue price minus flotation cost. Issue price minus flotation cost. The issue price is flotation cost is 5% of issue amount, 15% convertible of 100 each at par. So I've issued at par, 100 minus 5 rupees flotation cost, 95. Redeemable value is where a little bit of analysis is needed. The most important part is the redeemable value calculation. The redeemable value part is going to be higher of the two numbers. It can be redeemed as debt or get converted into equity share. So just give me a minute. So the redeemable value part, two options we have: redeem or convert. We can go for an option of redemption or we can go for an option of conversion. Redemption means I'll get redeemed at par. The redemption will happen at par. On maturity, debentures can be converted into 2 equity shares. Other option is redemption will happen at par, which is 100 rupees. Or it will get converted into shares. It will get converted into shares. Conversion option is it will get converted as 2 shares into some price. I want to know what is the likely price of this at the end of 6 years. It is basically 2 shares into price. We'll have to estimate what is the likely price at the end of 6 years. That price needs to be estimated. For that, I've been given some information in the question. First is cost of equity. Cost of equity is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. The risk-free rate is 10%. RF plus beta into RM minus RF. 10 plus 1.25 into risk premium is RM minus RF. That's directly given 18. 10 plus 1.25 into 18. 32.5%. That's the cost of equity. The cost of equity is 32.5%. 10 plus 1.25 into 18. Now what we are going to do is, the formula for KE is D1 by P0 plus growth rate. If I take it this side, KE minus G is equal to D1 by P0. D1 by P0. Now, I want to know the price at the end of 6th year. So what we can do is, I can make it as KE minus D is equal to D7 by P6. We can estimate the price like this: D7 by price of the end of year 6. You learn this better in the dividends chapter, but this is a calculation I can do. And net I can say P6 is equal to dividend of the 7th year divided by cost of equity minus growth rate. Cost of equity minus growth rate. Price at the end of year 6 is equal to 7th year dividend by cost of equity minus growth rate. So I need to know what is the growth rate. I need to know what is the growth rate, because I want to calculate the price at the end of year 6. For that, the simple calculation is get to know what is the dividend at the end of 7th year and divide by cost of equity minus growth rate. Cost of equity is calculated. 7th year dividend is today's dividend plus growth rate for 1 year, 2nd year, 3rd year, 4th year, 5th year, 6th year. You will have to keep adding that growth. So let's try to get the growth rate. For that, what they said is, the company recently paid a dividend of 12.76. 5 years ago, they paid a dividend of 10 rupees. So what we can say is, future value is 12.76. Present value is rupees 10. That is, whatever was paid earlier is called present value, whatever is paid later is called future value. Years is equal to 5, R equal to question mark, R equal to question mark. So I can say future value is equal to present value into 1 plus R power 5. 1 plus R power 5. Somewhere the question has given us the tables. So from the tables I can get to the answer. There are tables which are given below. Future value interest factor tables are there in the problem. So 12.76 is equal to 10 into 1 plus R power 5. I can say 1 plus R power 5 is equal to 1.276. From this table, I can say this is the R. 1 plus R power 5 is equal to 12.76. So from the table, I can say that the R should be 5%, because 5% and they have given the values 5 years, 6 years and 7 years. I want the 5-year values. I want the 5-year value. The rate of interest is 5%. So from given tables, we can say that R equal to 5%. Hence, growth rate equal to 5%. The growth rate is equal to 5%. Now we need to apply this formula. P6 is equal to 32.76 minus 5%. 32.76, it was some 32.5. Sorry, 32.5 minus 5%. I need to decide what is the dividend. So for that, what we will do, I have 12.76 in the calculator plus 5%, again plus 5% second year, plus 5% third year in the calculator, plus 5% fourth year, plus 5% fifth year, plus 5% sixth year, plus 5% seventh year. You'll have to keep adding this. So 17.95. 12.76 plus 5% for the first year, plus 5% for the second year, third year, fourth year, fifth year, sixth year. And finally, I can say 17.95 divided by 27.5%. P6 is equal to 17.95 divided by 27.5%. Divided by 27.5%. 65.27. So the price is 65.27 is the price at the end of 6th year. At the end of 6th year, The price is 65.27. At the end of 6th year, price is 65.27. That's the price we are going to have at the end of 6th year. I hope this is clear. So I'll give you time to write. Just write this. $65.27 is the price at the end of 6th year. And at any stage, if you're finding it difficult with the speed, just pause the video and note down things. So I'm doing this a home recording. So in case at any place, if there is a speed issue, just pause the video, note down things and then proceed ahead. So 2 into 65.27, 130.54 will be the redemption value. 130.54 is going to be the redemption value. 100 or 130.54, whichever is higher. $130.54. Now I need to put this in our normal formula and then get to the answer. So cost of debt is equal to interest after tax, average other cost, average funds employed. Interest after tax is 15 into 60%, 9 rupees. Average other cost is redeemable value minus net proceeds by life. Life is 6 years. Divided by average funds employed. 9 plus 130.54 minus 95 divided by 6 years, whole divided by 130.54 plus 95 by 2. So net it's going to be 9. $130.54 minus 95 by 6 years. Denominator is 130.54 plus 95 by 2. %13.23%. 13.23%. That's on the cost of debt side. Cost of debt is 13.23%. Same formula, convertible remains the same, just that the last number, the redeemable value part alone, you will have to be little careful. The redeemable value, it is higher of redemption as debt or conversion into shares. Note this. Keep noting this. Okay, I'll then do the next segment, which is cost of preference, a fairly simple segment, but they wanted us to use yield to maturity method. Yield to maturity is IRR method. IRR method. Let's do the basic information. Type of preference, redeemable. Type of preference, redeemable. Life is 10 years. Life is 10 years. Coupon is 5%. 4.5%, face value 100, tax rate is of no use. Net proceeds is issue price minus flotation cost. Issue price is 5% preference shares, each at a premium of 10%. So I've issued them at a premium of 10%. A company issues, the heading you'll have to read it like this. A company issues 5% preference share of 100 each at a premium of 10%. So 5% preference shares of 100 each at a premium of 10% has been issued by them. These shares are redeemable after 10 years. So issue price minus flotation cost. The issue price is 110. Flotation cost is 6% of issue price. $103.4 and redeemable value is at par rupees 100. Redeemable value at par is rupees 100. We need to calculate using IRR method. One good part is they have given some values below. So somewhere my answer is going to be somewhere here. The either 3 or 5%. Present value interest factor is normal factor, and interest factor annuity. They have given the annuity factor as well as the normal factor. I'll start with 3% and then do 5%. Year, cash flow, PVF, DCF. We'll first start with 3%. Then I'll move to 5% because these are the only two possible tables which I can use here. Year 0, 1 to 10, year 10. You can do this from a company point of view. You can do it from an investor point of view. Let me do it from a company point of view. Company will get 103.4. Every year, company is going to pay 5% preference. Every year, company is going to pay 5% preference. So 100 into 5%. And at the end of 10 years, it will get redeemed at 100. It will get redeemed at 100. This is outflow for the company. We'll use the factors given in the question. 10-year annuity factor for 5% is, so 3% is 8.8530. 8.8530. Sorry, 8.530. Sorry, 8.530. And the 10th year factor is 0.744. Negative NPV. Normally positive increase the rate, negative reduce the rate. Here we are working in the reverse manner. Initially I have inflow and then I have series of outflow. So in this type of problem, if you have negative NPV, you will have to increase the rate. No need to think much. 5% which is given in the question. 7.722. 0.614. One positive, one negative NPV. We have got one positive NPV, one negative NPV. And with this, we'll get to the answer for cost of preference using the yield to maturity method. Using the YTM method. Complete this. Complete this part. Complete whatever we have done till this. Okay, let's just get the IRR. Cost of preference, technically IRR. L1 NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. That's the formula, a slightly lengthier formula. L1 is the lower rate, NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 is the lower rate, which is 3. NPV at L1 is minus 13.65 divided by minus 3.39 plus 1.60, 4.6%. Nothing much for me to explain. The important part was the cost of convertible debt. This was a fairly simple part. Any doubts, you can just send me a message. Okay, let's now come to the second question in your cost of capital chapter. Bounce Limited evaluates all its capital projects using a discounting rate of 15%. The capital structure consists of equity share capital, retained earnings, bank term loan, and debentures which are redeemable at par. Rate of interest on term loan is 1.5 times that of debenture. Remaining tenor of debenture and term loan is 3 and 5 years respectively. Book value of equity share capital, retained earnings, and bank loan is 10, 15, and 10 respectively. Debentures are having a book value of 15 lakhs, currently trading at 97. P multiple for the share stands at 5. Rate of interest on bank loan and debentures. Go through the question. Go through the problem. Okay, now the first line of the question says, I am evaluating all my capital project using a discounting rate of 15%. In the investment decision chapter, we learned that discount rate is nothing but cost of capital, which is nothing but WACC. So indirectly, that 15% is the weighted average cost of capital. So I have WACC. I have data to calculate cost of equity, cost of debt, and term loan. We will calculate in terms of X. We'll calculate and somewhere get to finally identify what is the rate of interest on bank loan and debentures. That's the end requirement. I need to find out what is the rate of interest on bank loan and debenture. Let's first do a WACC table. Somewhere in the table, some of the items will get computed. Working note 1, WACC table. Source, cost, weight, product. Okay, before that, we'll have to write a line of explanation. The company uses discount rate of 15% discount rate of 15% for its project evaluation. For its project evaluation, discount rate is basically the WACC of company. That's nothing but cost of capital or weighted average cost of capital. So WACC is 15%. The discount rate is basically the WACC of the company. We have four forms of capital: equity, retained earnings, debentures, term loans, and overall. Equity, retained earnings, debentures, term loans, and overall. I'll come to cost of each of this as we proceed. Let's write the weight part alone. We'll do it in lakhs itself. We'll do these figures in lakhs. The weight of equity is 10 lakh. Retained earnings is 15 lakh. Debentures is 10 lakh. Sorry, debentures is not 10 lakh. Debentures is 15 lakh. Term loans, the bank loan part is 10 lakh. These are the weights given in the question: 10, 15, 15 and 10. 10, 15, 15 and 10. Now, cost of equity, note 1, cost of equity. See, the normal formula for KE is D1 by P0 plus growth rate. I can say KE is nothing but D1 is E1. E1 means earnings, because your dividends are paid out of the earnings of the company. Dividends are paid out of the earnings of the company. So I can say E1 by P0, no plus growth, because if you are paying out entire earnings as dividend, I'm basically assuming whatever I'm earning is paid out as dividend. If my payout ratio is 100%, retention is 0. If retention is 0, growth is 0. So what I can say is K is equal to E1 by P0. E1 by P0. And if you look at P multiple is nothing but P0 by E1, price by earning. E0 or E1, because there is no growth. There is no growth. All are same. P multiple is price by earning. Cost of equity is earning by price. Cost of equity is earning by price. This we learn in the dividends chapter. So I can say cost of equity as inverse of P multiple. Inverse of P multiple, 1 by 5, 20%. Inverse of P multiple. Cost of equity can be taken as inverse of P multiple. So I take this as 20. Retained earnings will be same. Both are 20%. Both are 20%. 10 into 20%. 15 into 20%. 10 into 20%. 15 into 20% into 20%. Inverse of P multiple. Cost of equity can be taken as inverse of P multiple. The cost of equity of an organization can be considered as inverse of P multiple. Okay, let's come to the cost of debenture, which is the very critical part. Interest after tax, average other cost by average funds employed. I have no idea what is the interest the company is paying. Let's assume the interest rate is X. The interest rate is X. So the interest which is going to be paid is on face value 100x. On the face value 100x. After taxes 100x, 75%. Redemption 100. Today's value 95. 100 minus 97, the net proceeds is 97. Life of the debenture is 3 years. Whole divided by average funds, 100 plus 97 by 2. I'll not try to get a answer because it's in x. We'll just simplify and keep it like this. 75x plus 1 by 98.5. 75x plus 1 divided by 98.5. So plus 1 divided by 98.5. Quickly note this. We are assuming the interest rate to be x. So interest amount is 100 into interest rate. Face value is 100. 100 into interest rate into 1 minus tax rate plus redemption value minus net proceeds by life. Redemption value minus net proceeds by life divided by redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. Note this. 100x into 75% plus 100 minus 97 by 3 divided by 100 plus 97 by 2. 100 plus 97 by 2. Simplified version is 75x plus 1 divided by 98.5. And cost of term loan is very simple. It is interest rate into 1 minus tax rate. Interest rate into 1 minus tax rate. And what we did is interest rate on debentures was x. Interest rate on term loan on debentures is x. Term loan is rate of interest on term loan is 1.5 times that of debenture. 1.5 times that of debenture. 1.5x. One point 125x. 1.125x. 1.125x. I think beyond this I don't have much to explain. 1125x plus 15 divided by 98.5. 98.5 is common denominator. This is 11.25x. The overall cost of capital is 15%. The overall cost of capital is 15%. 15 into 50 is 7.5. 15% into 50. So the sum of product 2 plus 3 plus 1125x plus 15 by 98.5 plus 11.25x is equal to 7.5. That is equal to 7.5. Once we solve this, you will get x. X is the rate of interest on debenture. 1.5 times of that is the rate of interest on term loan. You keep doing it. I'll give you some 2-3 minutes to solve x. Keep solving x. Keep solving this. 2-3 minutes for you to get the answer to x. You keep doing it. Get the answer to x. You do the solving part. Keep solving it. I get excess 10.36%. I'll explain 2 plus 3 plus 1125x plus 15 by 98.5 plus 11.25x is equal to 7.5. 2 and 3 goes to the other side. So 7.5 minus 5 is 2.5. 1125x plus 15 divided by 98.5 plus 11.25 is equal to 2.5. 98.5 is the common denominator. We make it common denominator. So it becomes 1125x plus 15. 11.25 into 98.5 is 1108.125x whole divided by 98.5 is equal to 2.5. 98.5 goes to the other side. 15 from this side becomes minus there, and you get excess 10.36%. Rate of interest of debentures is 10.36. Rate of interest of debentures. Rate of interest of debentures 10.36%. Rate of interest of term loans 10.36 into 1.5 into 1.5 times 15.54%. Excellent problem. Reverse working. We have to do reverse working and get to the answer. Rate of interest is debenture is 10.36 and term loan is 15.54. Term loan is 15.54. Just a validation for you. This is not needed in exam. So what would have been the rate of cost of debenture is 75 into 10.36% plus 1 divided by 98.5 into 100, obviously 8.9%. This is 8.9%. Term loan is 15.54 into 1 minus tax rate. Into 1 minus tax rate. Some rounding of gaps can be there in our final solution. We may have some rounding of gap impacting the final solution. And summation of this is 7.5. The sum of this is 7.5. So sum of product by sum of weights will give me the WACC. 7.5 divided by 15 gives me 15%. So rate of interest on debenture is 10.36. Term loan is 15.54. Once you form the equation, balance is more of max. That's more of max. With this, I'll end this question. If there are doubts, you can just send me a message. Hi friends, so let's now go to the additional question of your chapter 5, which is on financing decision, capital structure. There are two questions in this. The second question is an extremely lengthy question, but a good problem to revise most of the concepts of this chapter. Let's go through question 1 first. Particulars relating to Raj Limited for the year ended 31st March 2022 are given as follows. Output at normal capacity 1 lakh, selling price 40, variable cost 20, fixed cost is 10 lakh. The capital structure is equity share capital 10 lakh, reserves and surplus 5 lakhs, current liability 5 lakh, total is 20 lakh. It has decided to undertake an expansion project to use the market potential that will cost around 20 lakh rupees. Company expects an increase in output by 50%. Fixed cost will also increase by 5 lakh and variable cost per unit will be decreased by 15%. The additional output can be sold at the existing price without any adverse impact on the market. Following alternative scheme for financing is available. You have 3 alternatives. Interest rates are given. Find out which of the above alternative would you recommend with reference to EPS, assuming a corporate tax rate is 40%. Go through the question and then I'll start explaining it. This came in May 2022 exam. Go through the question. I'll explain once you have gone through the problem. Okay, let's look at this. Now, this is an optimum mix question where we are required to decide which is the best alternative on the basis of EPS. EPS is what they are giving us the basis. You have three options. You need 20 lakh. 5 lakhs can come in the form of debt, balance 15 lakhs in equity, 10 lakhs in debt, balance 10 lakhs in equity, 14 lakhs in debt, balance 6 lakh in equity. Now, when you do expansion, your output of 1 lakh will go up by 50%. So the output will go up, fixed cost will also increase, and variable cost per unit will decrease. So this will alter my EBIT, the EBIT which the business can. What will be EBIT? Sales less variable cost, contribution less fixed cost, and we'll call it as EBIT. That will be the EBIT, which is going to be different for the which is going to be same for all the alternative. Beyond that, the interest, other things can change. So what we normally do is we used to write what are the three alternatives, then calculate interest, preference, dividend, number of equity shares for the three alternative, and then start computing EPS. So working note 1, identification of alternatives. Working note 1, identification of alternatives. Identification of alternatives. Alternative 1, debt of rupees 5 lakh. It's there in the question, but we are still writing again. Debt of rupees 5 lakh and equity of rupees 15 lakhs. Please keep writing along with me. Debt of 5 lakhs and equity of 15 lakhs. Alternative 1 is debt of 5 and equity of 15. Alternative 2, debt of rupees 10 lakhs and equity of rupees 10 lakhs. Debt is 10 lakhs, equity is also 10 lakhs. Debt of 10 lakhs and equity of 10 lakhs. Alternative 3, debt of rupees 14 lakhs and equity of rupees 6 lakhs. Balance, I need 20 lakhs funding. In that, the debt component can either be 5 lakhs, 10 lakhs or 14 lakhs, and balance is going to come from equity, guys. The balance component will come from equity. We can either raise it as 5, 10 or 14 of debt. Working note 2, computation of interest and number of equity shares. I'm not writing preference dividend because it's not there. Number of equity shares for three alternatives. Interest and number of equity shares for three alternatives. Particulars and three alternative. Alternative 1, 2 and 3. Particulars and three alternatives. Particulars and three alternatives. Particulars and three alternatives. Interest cost, we are going to do it in the same format driven calculation. Interest cost, existing, new, total, number of equity shares, existing, new and total. Interest cost, existing, new and total. Number of equity shares, existing, new and total. Existing, new and total. The existing interest cost, we'll read the question if at all we get to know if there is any interest cost. Capital structure as of now does not have any borrowing. Equity share capital, reserves and surplus, current liability. So there is no existing interest cost. Existing equity shares is 1 lakh shares of 10 each. 1 lakh shares of 10 each. So existing shares are there, but I don't have existing interest cost. Now the new interest cost depends on how much we are borrowing. In the first situation, we borrow 5 lakh. Slab wise structure. First to 5 lakhs, you have to pay 10% interest. 5 to 10 lakhs for the extra, you have to pay 15% interest. And for above 10 lakhs, for that extra, you have to pay 20% interest. So the first one, 5 lakh into 10%. 5 lakh into 10%. Then 5 lakh into 10% plus another 5 lakh. 5 lakh into 10% plus another 5 lakhs into 15%, that extra portion. 5 lakh into 10 plus another 5 lakh into 15. This 5 lakh into 10 plus another 5 lakh into 15 plus balance 4 lakh. 4 lakhs into 20%, above 4 lakhs into 20%. This will give me the overall interest cost. 50,000. First 5 lakh into 10%, next 5 lakh into 15%, and next 4 lakh into 20%. So 5 lakh into 10, 5 lakh into 10 plus 5 lakh into 15, and 5 lakh into 10 plus 5 lakh into 15 plus 4 lakh into 20. They have not given issue price, so we assume that the issue price is equal to current market price. The assumption is whatever issue is going to happen, that will happen at the current market price of 200. So in this case, 15 lakh divided by 200, 15 lakhs, the balance amount, 15 lakh divided by 200, 10 lakh by 200, and 6 lakhs by 200. Whatever the balance issue, that will happen at the rate of 200. That's what the question has mentioned as the current market price. Looks very high as compared to the face value, but the problem has mentioned that, so we follow that. So overall shares is this: 107, 105, and 103. 107, 105, and 103. Complete till this. Complete the calculation. Okay, working note 3, computation of EPS. We normally start with EBIT. In this question, as I mentioned, I'll do sales less variable cost, contribution less fixed cost, and we'll get EBIT, then less interest, EBT, less tax, EAT, no preference dividend, EAES, number of equity shares, and EPS. So let's write the format first: particulars and 3 alternative. Particulars and 3 alternatives. Sales, particulars and 3 alternatives. Sales less variable cost, particulars 3 alternative. Sales less variable cost, contribution. We used to use this format for your leverages. Contribution less fixed cost, EBIT less interest, EBT less tax, EAT slash EAES, number of equity shares, and EPS. Please complete this. Write the format first: sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax, EAT slash EAES, number of equity shares, and EPS. Complete this. Okay, coming to the sales figure, I hope you have written the format. Complete the format. If completed, you can even start doing it. If you have doubt, you wait for my instruction. If there are doubts, you can let me know. Any doubts, please let me know. Sales is 1 lakh units will go up by 50%. 1 lakh units will go up by 50% and no change in the selling price. No change in the selling price. So 1,50,000 into 40 rupees. Into 40 rupees. Output 1 lakh will go up by 50%. Selling price will remain 40. No changes for any of the alternative, because what changes is beyond EBIT. The change will happen beyond EBIT. Variable cost per unit will decrease by 15%. Variable cost per unit will decrease by 15%. So 20 minus 15%, 17. 20 minus 15%, 17 rupees. So 1,50,000 into 17. Any change in variable cost will mean a variable cost per unit. Anyway, the problem clearly mentioned it is per unit change. 150 into 17. Contribution. Fixed cost of 10 lakh will go up by 5 lakh rupees. Fixed cost of 10 lakhs will go up by, increase by 5 lakhs. 15. We get EBIT, which is going to be same. EBIT is going to be same. EBIT will be same for all the three alternatives. Beyond this, it's a formality. Interest we have calculated. 50,000, 125, 205. The interest is different for different alternative. I take that from working note 2. EBT. EBIT less interest. EBT. I'll have to deduct tax. Tax is at the rate of 40%. Tax is at the rate of 40%. Tax at the rate of 40%. EAT. Tax at the rate of 40%. We get EAT. 1140, 1095 and 1047. EAT number. Number of equity shares, again we have done in working note 2. Number of equity shares. In case there are doubts, any calculation issues, please let me know. And I get earnings per share, whichever gives me maximum EPS. We get earnings per share. Let's do 2 decimals. 10.6, 10.43 and 10.17. Whichever gives us maximum EPS, we will go ahead with that alternative. Whichever gives us maximum earnings per share. Maximum earnings per share, we will go ahead with that alternative. So complete the table. This gives us the maximum. Whichever gives us maximum EPS, the company should go ahead with alternative 1. EPS of debt of rupees 5 lakhs and equity of rupees 15 lakhs in order to maximize EPS. Alternative 1, debt of 5 lakhs and equity of 15 lakhs in order to maximize EPS. In order to maximize EPS. Hope this is done. Anyone still doing, let me know. If you're still doing, please let me know. Any doubts, clarifications, let me know. Yeah, 10.6, 10.43 and 10.17. I'll go ahead with alternative 1 because that maximizes my earnings per share. Go through question 2. Gonna take a lot of time because it's not a complex question, but it covers so many areas to be done. So go through it. Some part of it maybe I'll do here. Some part of it you can also manage it. But let's see. You go through the question first. Keep going through. I'll be back in some 2-3 minutes. Okay, let's start going through the question. Let's start this. A financial advisor of Sun Limited is confronted with following two ways of raising 10 lakh, which is needed for expansion. Issue 80% of the funds, that is of the 10 lakh, 8 lakh rupees with 14% debenture, face value of 100, redeemable at premium of 10%, and balance by way of issue of equity shares at 33.33% premium. Alternative to raise 10% of funds by issuing 8% irredeemable debenture and balance by issue of equity shares at a current market price of 125. So you can issue at current market price of 125 or you can issue at 100 plus 33.33, that is 133.33. Currently you have an EPS of 21. Modernization and expansion will increase the EBIT by 2 lakh. So I need to know what is the existing EBIT. That will go up by 2 lakh rupees. Balance sheet is given below. Current liability, loans, reserves and surplus, equity share capital, face value of 100. However, the financial advisor is concerned that if you raise debt, it can have some effect. The average debt ratio, this we learnt in ratio analysis. Debt ratio is debt by debt plus equity plus preference, that is debt by capital employed. Debt by capital employed, if it's more than 35%, P multiple will be 7. the P multiple will be different. If the firm increases its equity capital by more than 10%, he expects that the P ratio will increase to 8.5 irrespective of the debt ratio. So one is they're saying if the debt ratio is more than 35%, the debt ratio is more than 35%, P multiple will be 7. If you increase your equity capital by more than 10%, equity capital, that is only the capital portion, not the reserves and surplus, the capital portion, if you increase this by 10%, he expects that the P ratio will increase to 8.5. Tax rate is 25%, dividend payout ratio is 60%, growth rate is 10% for calculating cost of equity. Which alternative is better? EPS, NPS, financial leverage, WACC and marginal cost of. So many things need to be done. I have to do EPS, I have to do NPS, I have to do financial leverage, I have to do WACC, I have to do marginal cost of capital. In order to do my EPS and NPS analysis, I will need what are the alternative, what is the interest cost preference, all that data is needed. And I also want to comment on the P multiple part. So working note 1, identification of alternatives. Question 2, working note 1, identification of alternatives. Alternative 1, I need 10 lakh rupees. The requirement is 10 lakh. 80% fund with 14% debenture. So issue 14% debentures of rupees 8 lakh. 14% debenture of rupees 8 lakh. And balance rupees 2 lakhs by equity shares. By equity shares. That's the first alternative. Second alternative is raise 10% of funds, only 10%, issue 8% irredeemable debentures of rupees 10%, 1 lakh, and balance rupees 9 lakhs by equity shares. Please write this. Two alternative, 80% and 20% is the breakup. So 80% through debentures, 20% through equity share, 10% through irredeemable debenture, balance 90% through equity share. Working note 2, computation of interest and number of equity shares. Interest and number of equity shares for the alternatives. Particulars and 2 alternative. Preference dividend is not there again, so I'm not writing them. Write the format. Existing new. Particulars alternative 1 and 2. Interest cost existing new total. Number of equity shares existing new and total. Existing new total. Okay, the existing interest cost is 10% long-term loan of 15 lakhs. 10% long-term loan of 15 lakhs, 150. This is the existing interest cost. Now, new interest cost is slightly tricky. It can be tricky, I think, for irredeemable. Okay, not much. Issue 80% of the fund with 14% debenture face value being 100 at par and redeem at a premium of 10%. Redeem at a premium of 10%. So 8 lakhs into 14%. 8 lakhs into 14%. 8 lakhs into 14%. And this is 1 lakh into 8%. Now what sometimes can happen is you can issue this at premium also. The face value is 100, we are issuing at par. If you issue at premium, the interest cost will be slightly different. For example, if I had issued this at 140 or 150, sorry, let's take 160 for the time being. So 8 lakh. If the issue had happened at 160, we would have issued 5,000 debentures. And on these 5,000 debenture, you would have paid 14 rupees interest. Because the interest is always paid on face value. Interest is paid on face value. So if you are issued it at 160 or some other rate, then the interest cost can't be 8 lakh into 14%. That you will have to take care. It can't be 8 lakh into 14%. 1 lakh 50, 1 lakh 50, 1 lakh 12,000, 8 lakh into 14% and 1 lakh into 8%. Equity shares, existing equity shares is 20 lakh by 100, face value of 100. 20 lakhs by 100. If this equity shares go up by more than 10%, if the equity shares go up by more than 10%, it will have a P multiple of 8.5. Else it depends on the debt ratio part. So we'll keep doing this. 20,000 and 20,000. News balance 2 lakh. Balance 2 lakh. Issued at 133.333. To avoid the rounding of gap, I'm writing like this. 33.333% premium. 2 lakh by 133.33. 1,500 extra shares. 2 lakhs divided by 133.333. 100 is the face value. 33.33% is the premium. 33.33% is the premium. 133.33333. Alternative 2, 2 lakh divided, sorry, not 2 lakh, 9 lakh. 7,200. 9 lakh by 125. 9 lakh by 125. Nine lakh by 125, issued at a price of 125. Issued at a current market price of 125. I hope this is clear. Working note 3, computation of EPS and MPS, EPS, MPS and financial leverage. Let's do all of them. EPS, MPS and financial leverage. EPS, MPS and financial leverage. Financial leverage. I'll use the format which we used earlier. Particulars, we will not have all this. We'll start with EBIT. I'll keep existing also for one purpose. Existing will help me in getting to know. Existing data will help us in getting to know what is the EBIT today. So existing, alternative 1 and 2. Last question we did not do that because the existing data was available indirectly. Here I have to do the existing EBIT calculation. EBIT less interest, EBT less tax, EAT, number of equity shares, EPS, P multiple and MPS. Write the format. EBIT less interest, EBT less tax, EAT, number of equity shares, EPS, P multiple and MPS. Okay, we're going to start with existing data. Existing data will help us in getting to know what is the EBIT, and then I can complete the alternative 1 and 2 analysis. In fact, I'll add one more item called as financial leverage. Some of this we will not do for existing. Some of this we will not do it for the existing. Now coming to the existing data, existing question has said the EPS is 21. We'll have to do reverse working. EPS is 21. Existing is 21 EPS. Existing equity shares were 20,000. 20,000. Existing equity shares are 20,000. Reverse working, existing EAT is 4,20,000. Existing EAT is 4,20,000. 4,20,000. Tax given in the question is 25%. So this is 25. This is 100. And this is 75. 25 is the tax. EAT is 75. EBT is 100. So if 75 is equal to 4,20,000, what is 100? So this divided by 75%. Tax is 25%. Tax is 25%. Tax is 25%. Existing interest cost was 1,50,000. Reverse working, existing EBIT 7,10,000. The existing EBIT is 7,10,000. The existing EBIT is 7,10,000. Existing EBIT is 7,10,000. This is the existing calculation. Let's come to the alternative 1 and 2. EBIT will go up by 2 lakh. EBIT will increase by 2 lakh because of expansion. So plus 2 lakh. 9,10,000. EBIT will go up by 2 lakh. Interest cost is 262, 158. Interest cost 262 and 158. 2,62,000 and 1,58,000. EBT 648, 752. EBT 648, 7,52,000. Tax is 25%. 25%. EAT, good chunk of it we have already done the calculation. Equity shares is 21,500 and 27,200. 21,500 and 27,200. EPS 22.6 and 20.74. The P multiple will depend. So P multiple part I'll just complete in some time. EPS is 22.6 and 20.74. 22.6 and 20.74. The P multiple depends on one, what is the debt ratio, because they've said if the debt ratio is more than 35%, the average debt ratio is 35%. If you exceed this, P multiple will be 7 times. Also, if there's an increase in equity share capital by more than 10%, the P multiple will be 8.5 irrespective of the debt ratio. Whatever be the debt ratio, it is going to be 8.5 times. So P multiple part will come in sometime. Financial leverage is EBIT divided by EBT. EBIT divided by EBT, earnings before interest and tax, divided by earnings before tax minus preference dividend and all we do, which is not there. EBIT by EBT. So till now, if you look at EPS, alternative 1 is better. If you go by EPS, financial leverage, alternative 2 is better because lower FL is better. Higher FL means higher risk. Higher FL is higher risk. So as of now, we have done only EPS and financial leverage. There are totally 5 parameters: EPS, MPS, financial leverage, WACC, WMCC. Now, in order to do the P multiple, I need the debt ratio. So next to note, computation of debt ratio. Computation of debt ratio. Debt ratio is debt divided by debt plus equity plus preference. Debt divided by debt plus equity plus preference. Particulars, alternative 1, alternative 2. This will also later help me in WACC calculation. It will help us in WACC calculation later. Alternative 1 and alternative 2. Particulars, alternative 1 and alternative 2. As of now, we have in the company equity share capital. I'm writing the existing ones. Reserves and surplus, 10% long-term loan, then 14% debentures we are going to issue in one alternative, and 8% irredeemable debenture. Total capital, total debt and debt ratio. I'll need one more item. I'll explain what is that needed. Equity share capital given in the balance sheet with some changes, obviously. Reserves and surplus in the balance sheet. 10% long-term loan in the balance sheet. 14% debentures is new. 8% irredeemable debentures is new. Write this. The existing capital is 20 lakh rupees. This will go up by 1,500 shares and 7,200 shares. The capital will go up by 1,500 shares and 7,200 shares. Balance in that, because we are issuing it at a premium, some amount will also get added to reserves and surplus. Number of shares will go up by 1,500 and 7,200. 1,500 and 7,200. So equity share capital 20 lakh plus 1,500 into 100. 20 lakh plus 1,500 into 100. 1,500 into 100. And 20 lakh plus 7,200 into 100. 1,500 into 100 and 7,200 into 100. Extra 1,50,000, extra 7,20,000. Extra, see, net extra addition will be 10 lakh. I'm just writing extra in the side. 150 I added here, 720 I've added for the second alternative. Reserves and surplus, existing is 10 lakh plus 1,500 into 33.333. 1,500 into 33.3333. 133.33 was the issue price. 10 lakh plus 1,500 into 33.3333. So this is extra 50,000. Extra 50,000. And 10 lakh plus 7,200 into 25. What is 25? 125 is the issue price. 125 is the issue price. 100 is the face value. Balance 25 will be added to securities premium. Balance 25 to securities premium. So extra is 180. Extra will be 10 lakh. This extra is also has some usage. I'll explain later. %, long-term loan remains same, 15 lakhs, 15 lakhs. No changes there. 14% debenture was extra 8 lakh, no irredeemable debenture. This side 1 lakh. So this is extra 8 lakh. This is extra 1 lakh. All put together, we will get extra 10 lakh. All put together, we will get extra 10 lakh of capital. So the capital now increases to 55 lakhs. The capital increases to 55 lakhs. Debt is these three items: long-term loan, debentures, redeemable, irredeemable. All this put together is the debt. Debt ratio is debt divided by total capital. Debt ratio is debt divided by total capital. Debt ratio is debt divided by total capital into 100 to express in percentage. 41%, 29%. If you go above 35, P multiple can come down to 7. If you go above 35, if you go above 35%, P multiple will go down to 7 times. P multiple will go down to 7 times. Apart from this, I also have percentage increase in equity capital. Why I am writing this also is, if equity capital increases by more than 10%, if the equity capital increases by more than 10%, P multiple will be 8.5 irrespective of what is the debt ratio. I am not bothered about the debt ratio. Whatever be the debt ratio, if there is an increase in equity capital by more than 10%. Earlier it was 20 lakh, so percentage increases. This minus 20 lakh divided by 20 lakh. Increase divided by 20 lakh. Increase divided by 20 lakh. Percentage increase. 2150 minus 20 lakh. Minus 20 lakh. 2720 minus 20 lakh. Minus 20 lakhs. Minus 20 lakhs. Applicable P multiple. Applicable P multiple. Applicable P multiple. The applicable P multiple is, in this case, debt ratio is more than 35 and increase in equity capital is not 10%. Debt ratio is more than 35 and increase in equity capital, the increase is not more than 10%, you will have only 7. You will have only 7. And in this case, debt ratio is also lower, equity capital has also gone up by more than 10%, it will be 8.5. See, this is the most important condition. If this goes up by more than 10%, 8.5. If this does not happen, then look at debt ratio. If debt ratio is more than 35, it is 7. So alternative 1 will have a P multiple of 7. Alternative 2 will have a P multiple of 8.5. Alternative 2 has lower borrowing. Lower borrowing means lower risk for the equity shareholders. So 7 and 8.5. 7 and 8.5 MPS. So based on MPS, we will go for alternative 2. EPS alternative 1, financial leverage alternative 2, MPS alternative 2, WACC and WMCC still pending. What needs to be done? I'll explain there. EPS, financial leverage and MPS. Let me know if there are any doubts. Please complete till this. EPS alternative 1 is better. Financial leverage alternative 2 is better. MPS alternative 2 is better. Okay, now I need to do WACC and WMCC, weighted average cost of capital and marginal cost of capital using book value weights. I'll do it for alternative 1. Alternative 2 is something you can manage. So, working note for computation of WMCC, WACC and WMCC for alternative 1. What is the difference? You'll understand. Source, cost, weight, two subcolumns, not book value, market value. Weight will have two subcolumns called as WACC and WMCC. What is the difference? You'll understand. Product, WACC and WMCC. Source, cost, weight, product. WACC and WMCC, weighted average cost of capital and weighted marginal cost of capital. I'm going to copy the numbers from here. I'll give you time to write. Let me just first copy these numbers. I'll give you time, wait for some time. WMCC means that additional capital. I kept on writing what is the additional amount. So the cost only for that additional capital. WMCC, marginal. Marginal means the cost only for the additional capital. So this, that additional number, 1,50,000 extra, 50,000 extra, 0 extra and 8 lakh extra. The cost only for the additional capital. The cost only for the additional capital. So source, cost, weight, product. You can write now equity capital, reserves, term loan, debenture. Irredeemable debt will not come for alternative 1. WACC, entire capital. WMCC, only the additional capital. Additional. What is additional? 2150 minus 20 lakh, 1050 minus 10 lakh and the new debenture. Write till this. Write till this. I'll give you maybe some 2 minutes. Complete noting this. I'll come to cost then. Equity capital, reserves, term loan, debentures, WACC based and WMCC based. WACC is the entire capital, WMCC is only that additional value. I'm doing only alternative 1. You will have to do alternative 2 as well. Okay, now let's come to the cost part of it. K is equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. Growth rate is 10%. Dividend payout is 60%. The percentage is 60, which is on EPS. EPS we calculated was 22.6. Now listen, this 22.6, the EPS which you have calculated, can be taken as current year EPS or the next year EPS. I don't know, it can be taken either ways. So I think ICI took it as current year, and then into 60% when you do, you will get D0. 22.6 is the current year EPS, into 60% is the current year dividend, add growth rate, divided by P naught. P naught is, we calculated, I think, 158.2. 158.2, and growth rate is 10%. 22.6 into 60% plus 10%. 22.6 into 60% plus 10 divided by 158.2 plus 0.10. 22.6 into 60%, add 10% on top of this and divide by 158.2. 0.0943 plus 0.10, 0.1943, or technically 19.43%. 0.0943 plus 0.10, 19.43%. 19.43%. That will be the cost for equity as well as reserves. That is the cost for equity capital as well as reserves and surplus. I am repeating, I am assuming 22.60 is the current year EPS. Based on that current year dividend, add growth rate. And price is also current year price. The denominator we have taken as current year price, P naught. Current year price, P naught. 22.6 into 60% plus 10%. Divide by 158.2 plus 0.10. I think there is some error in the ICA solution for this question. I've corrected that error. I think in the cost of equity, they missed adding the growth rate. Cost of long-term loan. Basically, interest rate into 1 minus tax. Whenever we don't have any extra information, cost of debt is interest into 1 minus tax rate. Interest into 1 minus tax rate, 10 into 1 minus 25%, 7.5%. Long-term loan, 7.5%. Long-term loan, 7.5%. This will not come in WMCC calculation because this is not any new addition. There's no new addition in long-term loan. Debenture, we're going to issue debenture at face value of 100 and redeem at 110. Issue at 100, redeem at 110. So cost of debt is equal to interest after tax, average other cost, average funds employed. average funds employed. Interest after taxes, face values 100. So you'll be paying interest of 14%. So 14 into 1 minus 0.25 interest after tax. Interest after tax 14 into 1 minus 0.25. Redeemable value 110. Redeemable at 10% premium. Net proceeds today's price divided by life. 110 plus 100 by 2. 14 into 1 minus 0.25 plus 110 minus 100 by 10 whole divided by 110 plus 100 by 2. 110 plus 100 by 2. 14 into 0.75. 10.5 plus extra 1 rupee divided by 105. 14 into 1 minus tax rate. 110 minus 100 by 10 redeemable value minus net proceeds by balance life divided by redeemable value plus net proceeds by 2. Redeemable value plus net proceeds by 2. So 11.5 divided by 105. 10.95. Obviously into 100 was done. 10.95%. That's all. So sum of products for WACC by sum of weights of WACC will give you WACC and same for WMCC. So this into this percentage. I think this part I'll do it quicker. Same thing for WMCC. Cost into the WMCC weight. Total. WACC and WMCC. Cost into weight is the product. Sum of product by sum of weights is the WACC and WMCC. 821 by 55 lakhs and 126 by 10 lakhs. I've done for one alternative. You will have to do it for the second alternative and then we compare. So I'll show that comparison part alone. Sum of product by sum of weights. Do it. I'll wait for maybe 2 minutes. WACC and WMCC. I'll then just show the comparison to make the conclusion. You anyway, first please complete this part. Please complete this part. Okay, let's just look at the conclusion part of it now. So This we have done 14.94 we have done. This was for alternative 1. Alternative 2 I said I want you to do, which is 14.75. The next alternative would have been 14.75. WMCC is 12.65. This is 16.58. So if I go by WACC technique, I'll go with alternative 2. WMCC alternative 1. So few techniques are saying alternative 1, few techniques are saying alternative 2. Few of the items are going with alternative 1. WACC, lower WACC is preferred. Alternative 2, WMCC, alternative 1. Yeah. So my final conclusion is going to be like this. EPS and WMCC go with alternative 1, or go with alternative 2 MPS financial leverage. I cannot give a conclusion. So summary of the solution is like this. Some alternatives or some parameter will prefer alternative 1, some parameter will prefer alternative 2. I think alternative 2 calculation you can complete it. I hope there are no doubts. If there are doubts, you can let me know. Else I end this question. If there are doubts, please let me know. Else we end this. Okay, thank you. Hi friends, so let's now move to chapter 6, additional material question. It's a problem on leverages. Akshar Limited has a sales of 68 lakh with a variable cost ratio of 60%, fixed cost of 1632, capital comprised of 12% debt, rupees 1 lakh, preference share of 10 each, carrying a dividend of 10%, 1 lakh 50,000 equity share, tax rate is 30%. At current sales level, determine the interest, EPS and amount of debt. If a 25% decline in sales will wipe out all the EPS. Go through this. Go through the question. Okay, let's do this. Here we are required to identify the interest, EPS and amount of debt. Moment you get interest, amount of debt is interest divided by the interest rate. Whatever is the interest you are paying, if you divide by 12%, you will get the debt figure. There is one understanding which says a 25% decline in sales will wipe out all the EPS. This is where that leverages understanding will help you. Let's first put this data in the format of leverage. So income statement, our normal format on leverages, particulars and amount, let's put the format first. Sales less variable cost contribution less fixed cost EBIT less interest EBT less tax. I think the tax rate is 30%. EAT, preference dividend is there in this question, less preference dividend. EAES, number of equity shares and EPS. This is the format we follow. So let's complete the format first. Write it starting from sales till EPS. Starting with sales till EPS. Complete writing the format first. Complete the format.
So sales is 68 lakhs. Data given in the question. I hope you have written the format. Sales is 68 lakhs. Variable cost is 60% of sales. Variable cost is 60% of sales. Contribution 2720. Fixed cost is 1632. EBIT number. Sales is 68 lakh. Variable cost is 60% of sales. Get the contribution. Fixed cost is 16 lakh 32,000. Get the EBIT figure. 10 lakh 88. Interest is something I have to calculate using the leverages understanding. EBT is not there, tax is not there, EAT is not there. Preference dividend can be calculated. I have 1 lakh, rupees 1 lakh. It is rupees 1 lakh preference share of 10 each with a dividend rate of 10%. Rupees 1 lakh. So 1 lakh into 10%. It's not 1 lakh share. It is rupees 1 lakh. Preference dividend is 10,000. 10,000. EAES is not known. Number of equity shares is 1,50,000. So we have captured all the information given in the question. Sales 68, variable cost 60%, contribution, fixed cost is there, EBIT, preference dividend is 10,000, number of equity shares is 1,50,000. We have captured all the basic information. All basic information has been captured. Okay, now let's see what is the leverages use here. Question says combined, it says a 25% decline in sales will wipe out all the EPS. A 25% decline in sales will wipe out the entire EPS. The entire EPS will become zero technically. So a 25% fall in sales will lead to 100% fall in EPS. A 25% fall in sales will lead to 100% fall in EPS. And we have combined leverage which is going to link a combined leverage which is going to link the percentage fall in sales with the percentage fall in EPS. Percentage fall in sales with percentage fall in EPS. So below leverage analysis. Leverages analysis. Leverages analysis. 25% decline in sales will wipe out entire EPS. That is, EPS will fall by 100%. EPS will fall by 100%. Will wipe out the entire EPS. That is, EPS will fall by 100%. Combined leverage links percentage change in sales with percentage change in EPS. Percentage change in sales with percentage change in earnings per share. The link is through combined leverage. Sales and EPS change is linked through combined leverage. So I can say combined leverage is equal to change in percentage change in EPS by percentage change in sales. This will give me the answer 100 by 25, 4 times. Complete this. Let me know if there are doubts.
Wiping out the entire EPS would mean a 100% fall in EPS. Wiping out the entire EPS is basically 100% fall in EPS. So combined leverage is basically 100 by 25 4 times. Combined leverage is 4 times. Combined leverage is 4 times. Then I will finally need the financial leverage to get interest figure. So what we can say is operating leverage. Operating leverage is equal to contribution divided by EBIT. Contribution divided by EBIT. 27 lakh 20 divided by 10 lakh 88,000. 2720 by 1088. 2.5 times. Operating leverage is 2.5 times. Using this, I'll get the financial leverage and then we'll get to the interest figure. Combined leverage is equal to operating leverage into financial leverage. 4 times is equal to 2.50 into FL. FL equal to 4 divided by 2.5. 1.60 times. Your financial leverage is 1.6 times. Combined leverage was 4 times because a 25% fall in sales was wiping out the entire EPS. The entire EPS would have got wiped out. So 4 times was combined leverage. Operating leverage is 2.5 times. Using that, the financial leverage is 1.6 times. Any doubts on this? Any doubts on this part? I hope you have written till this. Let's use the formula now. FL is equal to EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. EBIT divided by EBT minus PD divided by 1 minus tax rate. 1.60 is equal to 10,88,000 EBT minus 10,000 1 minus 0.3. 10,000 divided by 1 minus 0.3. I'm swapping this now. EBT 10,000 divided by 0.7. 14,286. 10 lakh 88. This side 1.6 comes. So we have swapped this. We have taken the denominator to the other side and 1.6 has come here. This will finally give me the EBT figure. And I think with that the problem is almost over. Financial leverage formula we have used. 1.6 is equal to 1088 divided by EBT minus 10,000 divided by 1 minus 0.3. This went there. EBT is equal to 1088 divided by 1.6. 1088 divided by 1.6. 6,80,000 plus 14,286. EBT is 6,94,286. EBT is 6,94,286 is the earnings before tax figure. 6,94,286. We are kind of done with the question now. EBT is 6,94,286. So we put this here. Balancing figure is interest, which is one of the requirement of the question. Interest is balancing figure. interest is balancing figure, tax at 30%, EAT 486, EAES, earnings per share. $3.1733. There were three requirements. One was the interest, EPS, and amount of debt. Interest, EPS, and amount of debt. Complete the table. Let me know if there are doubts. Any doubts, please let me know. Interest is 393,714. EPS is 3.1733. Amount of debt is whatever interest we are paying, divide that by 12%. Whatever interest we are paying, divide that by 12%. Why 12%? Because 12% is the rate of interest. 12% is the rate of interest. So amount of debt is some approximately 32,81,000. That's the approximate answer. 80,950. Clear? Any doubts in this? With this, the extra question on leverages get over. Any doubts?
Hi friends, so I'm recording this video for the additional questions which are there in the additional material which has been shared. I'll take you through the question on investment decision chapter. Alpha Limited is a manufacturer of computers. It wants to introduce artificial intelligence while making computers. The estimated saving from the introduction of the artificial intelligence is as follows. Reduction of employees with annual salary of 3 lakh each, reduction of 3 lakh in production delays, reduction in lost sales, gain due to timely billing, purchase price for installation is 20 lakh, installation cost is 1 lakh, 80% will be paid in the year of purchase, remaining will be paid in next year. Estimated life of the system is 5 years, will be depreciated on SLM basis. However, the operation requires 2 computer specialists with annual salary of 5 lakh per person. In addition, we are also going to incur annual maintenance and operating costs for 5 years. Year and the maintenance and operating cost. Maintenance and operating costs are payable in advance. Company's tax rate is 30%. Required rate of return is 15%. We are required to evaluate the project using NPV and profitability index. Go through the question. Okay, now let's understand what is the requirement of the question and why are we doing this question in the additional material. There is one adjustment which is unique as compared to the normal problems we have done in the class, and that's the reason why I'm discussing this question. End objective is to compute NPV and profitability index, for which I need the cash flow. The important part is your maintenance and operating costs are payable in advance. What we normally see is these items would be paid only at the end of the year. In this question, they are paid at the beginning of the year. They are paid at the beginning of the year. This is going to have some impact on my cash flow computation. So how is this going to impact us? This is a problem on cost reduction as well as revenue enhancement. I'm planning to introduce some artificial intelligence. So I will save on employee cost. I will save on some inventory problem related cost. Lost sales reduction will be there. There is going to be some gain due to timely billing. All these are benefits for me. There are certain expenses which I need to incur on computer specialist, and the most important part is how do I factor this maintenance and operating cost. That's the critical aspect in this question. Let's understand this. Working note 1, initial outflow. Working note 1, initial outflow, particulars and amount. Initial outflow, particulars and amount. Point number 1, capital expenditure. Point number 2, working capital. There's another point number 3 which is going to come. I'll explain. Capital expenditure and working capital initial will write. There's another item which is going to come in this. Capital expenditure is purchase price is 20 lakh, but I am going to pay only 80%. I'm going to pay only 80%. What matters to us is what is the outflow. What matters to us is what is the actual outflow which is happening. So capital expenditure is 20 lakh into 80%. Balance 20% will come in the first year. 16 lakhs is the capital expenditure. I don't have working capital here. I have installation expenses. 1 lakh is installation. This will get added to the cost of the asset only. 1 lakh is installation expenses. Apart from this, I am going to pay maintenance and operating cost in advance. I'm going to pay maintenance and operating cost in advance. So whatever is the maintenance operating cost for first year, I am going to pay that in today, year 0. Maintenance and operating cost is payable in advance. So maintenance, operating cost, year 1 cash flow will come in year 0 because we are paying at the beginning. It will also come in between flow. Why does it come? You'll understand as we proceed. Initial outflow. Overall outflow is 19 lakh rupees. The initial outflow is 19 lakh rupee. 16 lakh towards capital expenditure, nil towards working capital, installation expense of 1 lakh, and maintenance and operating cost. Maintenance and operating cost is another 2 lakh rupees. Working note 2, in between flow. In between flow, particulars and 5 different years. Reason for 5 different years is your maintenance and operating cost changes for each of the year. Particulars and 5 years. I hope there are no doubts on initial outflow. You have capital expenditure, installation expenses, and maintenance and operating cost. The first year maintenance and operating cost will come in year 0. The first year maintenance and operating cost will come in year 0. In between flow, saving in salaries. Saving in salaries. 5 employees into 3 lakh. 5 employees into 3 lakh rupees. Saving in salaries, 5 employees into 3 lakh rupees. Reduction in production delay cost. Reduction in production delay cost. Another saving for us. All these are benefits. Reduction in lost sales. 2 lakh 50. Gain due to timely billing. Gain due to timely billing. Nothing much for me to explain. Every year it's the same amount. Gain due to timely billing 2 lakh rupees. Less computer specialist. You will need 2 employees. You will need 2 computer specialists with an annual salary of 5 lakh per person. You will need 2 computer specialists with an annual salary of 5 lakh per person. So computer specialist is 10 lakh rupees. Computer specialist is 10 lakh rupees. Less maintenance and operating cost. This will come in my P&L because this is going to reduce my tax outflow. It is paid in advance. That adjustment I'll explain what we can do. Paid in advance is a new or an adjustment which I'll have to do after calculating the normal CFAT. So this I'll have to subtract that year in the respective year only. 2 lakh, 1 lakh 80, 160, 140, 120. How paid in advance will be reflected, you'll understand, because for tax calculation I have to subtract in this manner only. For the tax computation we will have to do subtraction like this. Less depreciation. 20 lakh was the cost of the asset. We have paid only 80%, but I can claim depreciation on the entire amount. 20 lakh is the cost of the asset. 1 lakh is the installation cost, no salvage value. So 21 lakh divided by 5 years. 21 lakh by 5 years. Depreciation. We get profit before tax less tax, profit after tax. Profit before tax less tax and profit after tax. Profit before tax for each of the year. The only difference is that maintenance and operating costs, there are also some extra adjustment needs to be done. Tax is at the rate of 30%. Tax at 30%. Profit after tax. Profit after tax. Tax at 30%. Profit after tax. Now the important adjustment. This maintenance is something I should not have subtracted because it is paid in advance. The numbers are not right. So what we do is we add this back. We add back. Why I deducted it? To calculate the right tax amount. So add depreciation, add back maintenance cost. Add depreciation, add back maintenance cost. Two items, whatever you have done, you are reversing them. You are reversing them. Add depreciation, add maintenance cost, add back the depreciation quantum and add back the maintenance cost. Maintenance should not have been subtracted because the amounts are not right. We are paying in advance, but we still went ahead. That is perfectly fine, not a problem, because we are paying maintenance in advance. So I have added back because tax was to be calculated. After this, less maintenance cost. Less maintenance cost. This is technically year 0. This is year 1. This is year 2. This is year 3. And this is year 4. Payable 1 year in advance. We are paying 1 year in advance. So minus 1,80,000, whatever you paid for the second year in the first year. Beginning of second year is end of first year. Minus 160, minus 140, minus 120. And the 2 lakh was considered in year 0 outflow. 2 lakh was considered in year 0 outflow, less maintenance cost. The amounts are paid a year in advance. The amounts are paid a year in advance. Less payment for original machine. What we did is we paid 80% in the year of purchase, remaining in the first year. So balance 4 lakh rupees. 80% of 20 lakh was paid. Balance you will have to pay now. Balance you will have to pay now. Balance you will have to pay now, and that gives me the cash flow. Revised CF80. Revised cash flow after tax. These are the cash flow numbers for each of the year. The problem is almost over now. Revised CF80. Important part is maintenance. I have subtracted the maintenance cost. Why did I subtract? Because calculation of tax will happen with the respective year maintenance cost. But from a cash flow point of view, we are paying that in advance. So I deducted it, added back, and then subtracted the respective year maintenance. Respective year maintenance. Working note 3, terminal flow. Terminal flow. Working note 3. I hope till this it's fine. Note this. Net salvage value. The book value of the asset after 5 years is 0 because it's fully depreciated. Sale value is also 0. Question is not mentioning about any salvage value. There's no reference of a salvage value. So net salvage value is 0. Recapture of working capital is also 0. Recapture of working capital is also 0. Total terminal flow. Total terminal flow. They've asked for NPV as well as profitability index. We can get both computation of NPV and profitability index. Technically, this is not my job. Beyond this, it's a fairly simple thing. Year cash flow, PVF at 15%, DCF. The numbers are there with you in all the 4 steps. Sorry, the 3 steps. From there, we'll have to pick the numbers and write it. Year cash flow, PVF, DCF. Year 0 to 5 years. Initial outflow was 19 lakhs. First year inflow 481. Second year 895. Third year 909. Fourth year 923. Fifth year 1037. Discount that at 15%. Discount at 15% and DCF. I don't have much to explain here. The most important part is maintenance. You will have to consider maintenance in the normal manner in step 2. Listen. Deduct maintenance in the normal manner in step 2. After deducting, add back the maintenance and then subtract the maintenance which is paid. For example, second year maintenance is paid in the first year. So you have to subtract in year 1 the second year maintenance. NPV. positive NPV, we can go ahead with the project, evaluate the project, we can go ahead. And profitability indexes inflow by outflow. Inflow divided by 19 lakhs. You can express this in percentage or in times. Both are fine. 144.03% or 1.44 times. This was an extra problem in capital budgeting chapter. If you have any doubts, you can just send me a message in WhatsApp. I'll clarify this.
Hi friends, so let's do the extra questions of risk analysis and capital budgeting now. I think we have two questions in this area. Let's go through the first question, which is on sensitivity analysis, and then the second question is on RADR approach. P Limited is considering a project with the following detail: initial cost, annual inflow, project life, cost of capital. Measure the sensitivity of the project to the changes in initial project cost and annual cash inflow, taking each factor at a time such that the NPV becomes zero. Identify which of the two factors the project is most sensitive to affect the acceptability of the project. Go through this. Go through the question. Please go through the problem. Okay, we are required to compute sensitivity, or we are required to do sensitivity analysis, and here the NPV has to become zero. There are two types of sensitivity analysis we do. One, they give a percentage change in the input parameter and they ask what is the impact on NPV. Second is, we'll have to make the changes such that the NPV becomes zero. So let's first calculate the base NPV and then we'll see how NPV can become zero. Working note 1, computation of NPV. Computation of NPV, year cash flow, PVF at 10% and DCF. Year cash flow, PVF at 10% and DCF. Let's first get the NPV numbers. PVF at 10% and DCF. Year cash flow, PVF, DCF. I think 4 years numbers. Year 0, 1, 2, 3 and 4. 4-year cash flow. Initial outflow is 1 lakh. Initial outflow is 1 lakh. 1 lakh. First year inflow 30,000. Then 40. Then 50. Then 60. Inflows for the 4 years. This is a normal simple calculation. 4 years number. PVF at 10%. 1 divided by 1.1. 1 divided by 1.1 and you get your DCF. You get the DCF. Total of DCF will give us the NPV. Complete till this. NPV. Complete till this.
get the base NPV number. Get the base NPV number. 38,840 is the base NPV. Now let's do sensitivity analysis. Sensitivity analysis on project cost. As of now, my project cost is 1 lakh rupee. NPV will become 0 if the project cost increases by 38,840. As of now, the project cost is 1 lakh. This will become, or this, if this increases by 38,840, NPV will become 0. NPV will become 0. So sensitivity analysis is project cost is currently rupees 1 lakh, is rupees 1 lakh. NPV will become 0 if the project cost increase by 38,840. If the project cost increase by 38,840, sensitivity percentage is equal to change by base into 100. Change by base into 100. 38,840 by 1 lakh, that is, the change is 38,840, and from a base of 1 lakh, 38.84%. That is, if the project cost increased by 38.84%, the project will have 0 NPV. If the project cost increased by 38, and if it increases beyond, project will get rejected. Sensitivity analysis basically tells how much change can you accommodate. I can accommodate a change of 38.84%. If the change is beyond this, project will get rejected. If the change is beyond 38.84%. Next, sensitivity analysis on, they wanted on project cost and annual inflow. Sensitivity analysis on annual cash inflow. On annual cash inflow, PV of annual cash inflow is, that is today is 1,38,840, is rupees 138,840. 138,840. NPV will become 0. How 138,840 is? If you add all the inflow, you will get it, or outflow plus the NPV. NPV will become 0 if the annual cash inflow present value, decrease by, in our project cost we said increase by, here it's decreased by 38,840. That is from 1,38,840 if the present value of inflow becomes only 1 lakh. From 138,840, if it becomes 1 lakh, NPV will be 0. Same thing, sensitivity percentage is equal to change by base into 100. Change by base into 100. 38,840, 1,38,840 into 100. 38,840 divided by 138,840 into 100.
27.97 percentage. 27.97 percentage. The sensitivity percentage for the initial outflow is 38%. Inflow is 28% broadly. So I can say the project is most sensitive to annual cash inflow. That is, if my annual cash inflow falls by more than 28%, project will be rejected. But in case of initial cost, even if it increases by 28%, I don't have a problem. Any increase beyond 38.84 is only the problem there. So project is most sensitive to the factor of annual cash inflow. 38.84, 27.97, annual cash inflow is the most sensitive factor. I hope you have noted this. Let me know if there are doubts. If there are any doubts, please let me know. Any doubts on this, please let me know. I hope you have noted this. Complete this. If there are doubts, please let me know. A simple question. We have done similar problems in our regular class as well. A similar requirement is only there in this question. Okay, let's move to the second question. Consider the below mentioned table for the risk premium and the coefficient of variation. Coefficient of variation and risk premium. Company is evaluating two projects with an initial investment of 1,50,000 for each project, with cash inflow from them occurring at the end of 5th year, which depends on possible scenarios: super, better, moderate, bad, and worse. If the ongoing government bond yield is 6%, identify which project to be undertaken. Go through this. Go through the question. Go through this. Okay, now in this question, the first table says, based on the coefficient of variation, the risk premium for the project will be determined. What the use of risk premium is? Risk free rate plus the risk premium will give you the risk adjusted discount rate. Risk free rate plus the risk premium. The risk premium depends on CV. The risk premium is going to depend on coefficient of variation. So here what we are going to do is we are going to first compute the coefficient of variation. How do you compute coefficient of variation? Risk divided by return. Risk is standard deviation. Return in this case is expected cash flow. The cash flow is going to come only in 1 year. So cash flow is going to come only once. So risk divided by return. Let's first compute coefficient of variation and then we answer. Working note 1, computation of coefficient of variation. Computation of coefficient of variation. Coefficient of variation
project X, coefficient of variation, project X, cash flow, probability, product, deviation, PD square. Cash flow, probability, product, deviation and PD square. Cash flow, probability, product, deviation and PD square. Probability, product, deviation and PD square. We'll do this in thousands to avoid so many zeros. In thousands. I can even do it in lakhs also, but okay, let's do it in thousands. Cash flow, probability, product, deviation and PD square. Cash flows are given 5 lakh 500, 3 lakh 300, 150, 50 and 10. This is the cash flow number. Probability is 0.2, 0.3, 0.15, 0.20 and 0.15. Probability numbers. Cash flow into probability is product. Cash flow into probability. Cash flow into probability. So this is basically expected cash flow. Cash flow into probability will give you product. Expected cash flow 224,000, which is 2,24,000. The expected, that is in the fifth year, only one time you are going to get it. In the fifth year, you are likely to get a cash flow of 2,24,000. You are likely to get a cash flow of 2,24,000 in the fifth year, only one time cash flow. It's only one time. They have not mentioned will occur at the end of fifth year. Cash inflow occurring at the end of fifth year. Deviation is 500 minus 224. 500 minus 224. 300 minus. So keep subtracting. 500 minus 224. 300 minus 224. 150 minus 50 minus and 10 minus. Deviation. PD square is probability into deviation into deviation. Probability into deviation into deviation. Complete till this. I'll wait. Probability into deviation into deviation. Complete the calculation. Probability into deviation into deviation. Complete this calculation. I'll wait. Probability into deviation into deviation. Keep doing this. Complete the table.
expected cash flow is 224,000, variance is 3714. I'll take a square root and then multiply with 1000 because we are doing the problem in thousands. The entire problem is being solved in thousands. So expected cash flow 2,24,000. Expected cash flow 2,24,000. Standard deviation. Standard deviation. Square root of this, and we'll convert in thousands. 175 254. Standard deviation square root of 30714 and multiplied with 1000. Multiplied with 1000. 175 254. Coefficient of variation. Coefficient of variation. Coefficient of variation. Standard deviation by return, risk per unit of return. Standard deviation by return, I'll keep it 4 decimals or 2 decimal, anything is fine. 0.7824. Coefficient of variation 0.7824. Coefficient of variation 0.7824. 0.7824. And based on this, the applicable risk premium is 6%. Applicable risk premium is 6%. From that table, applicable risk premium is 6%. 6%. And discount rate is 6 plus 6. What is 6 is the risk free rate. Government bond. Government bond is yielding 6%. Government bond is yielding 6%. So 6 plus 6. We'll use 12% discount rate and get the NPV. For this project, the expected cash flow is 224. Standard deviation is 175 254. Based on that, I got coefficient of variation. Based on that, I got the risk premium. And based on that, we finally got the discount rate, which is 6 plus 6, 12%. 6 plus 6, 12%. Any doubts on this? I hope this is clear. We'll do the NPV in some time. Let's do the similar calculation for the next project also. Project X, we have got all the 5 numbers, that is cash flow, standard deviation, coefficient of variation, based on the risk premium, based on the discount rate. Let's do project Y. You start doing it. I'll give you maybe some 3-4 minutes. Start doing 3-4 minutes and then I'll do it. Please keep trying. 3-4 minutes for you to do. I'll be back. You keep doing it. I hope you have done this. I'll anyway start doing it now. 400, 350, 250, 75, 5. Probabilities are 0.3, 0.2, 0.2, 0.2 and 0.1. So overall number is 255.5. You get the deviation, multiply, and then you get to these numbers. Overall total is 20,847.25. Some up and down rounding of differences can be there. 20,847.26. Expected cash flows 255,500. Standard deviation 144,386. Coefficient is 0.5651. 0.5651. 0.5651. And based on the table, I can say risk premium is 4%. Based on the table, I can say risk premium is 4% and discount rate is 6 plus 4. 6 plus 4. The discount rate is 6 plus 4, 10%. 6 plus 4, 10%. The earlier risk premium is 6%, now it is 4%. Let's do the NPV calculation. The purpose of doing this calculation was to get to the discount rate, because the risk premium is the extra portion depends on the risk of the project measured through coefficient of variation. Computation of NPV. Project X year cash flow PV of DCF. Project X year cash flow PV of DCF. PVF at 12%. Project X is PVF at 12%. We got 12% using the risk element. Year 0, year 5. Year 0 and year 5. Year 0 and year 5. Initial outflow is 1,50,000 and fifth year inflow was 224. Negative 150 and positive 224. NPV is negative for project X. Negative 150 is the initial outflow and the final inflow is 2,24,000. 224. Negative NPV. Project X will get rejected. Project X will get rejected. Negative NPV. Project Y, this will be 255,500 and this discount rate is only 10%. I'll give you time to write. In case there are any doubts, let me know. PVF at 10%, NPV is positive here. The risk adjusted discount rate kept on changing based on the coefficient of variation. If you have a very high coefficient of variation, it means higher risk. Project X negative 22,000. Project Y 8,666. 8,666. Negative 22 and 8,666. Negative 22,000 and 8,666. 8 triple 6. 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 8 Which project to be undertaken? I'll go ahead with project Y. We will go ahead with project Y because the same results in positive NPV of 8,666. It results in positive NPV of 8,666. We will select project Y. $7,824, we got 12%. 5,651, we got 10%. Negative 22, positive 8,666. So I'll go ahead with project Y. We will go ahead with project Y. I hope you have noted it. In case not, then you can just quickly note it down. Let me know if there are doubts. Any doubts, please let me know. If there are doubts, please let me know. Else I kind of end this. Okay, thank you, friends. Hi, friends. So let's now go to the additional question in your chapter 9, which is on dividend decision. Ordinary shares of a listed company are currently trading at rupees 10 with 2 lakh shares outstanding. Company anticipates that the earnings will be 5 lakhs for the next year. Cost of equity is 15%. Certain investment proposal which will cost an additional 26,089 shares to be issued if dividend is paid, and 47,619 shares to be issued if dividend is, sorry, if no dividend is paid, 26,089, 47,619 if dividend is paid. Applying the hypothesis, calculate the amount of investment and dividend that is under consideration by the company. Go through this. Go through the question. Okay, let's look at this now. It is on your hypothesis. What we normally used to do in an problem is they used to give us the price and the dividend. Everything used to be given in the question, and we were kind of using that information and proving the fact that the value will remain same. So here also the overall value is going to remain same whether the dividend is paid or dividend is not paid. Let's capture this in the normal format we do. Let's capture the data. analysis, particulars, dividend paid, dividend not paid, dividend paid and dividend not paid. Dividend paid and dividend not paid. Point number 1, opening price. Opening price, that is price at the beginning of the year, 10 rupees, trading at 10. Currently trading at 10. Cost of equity, 15%. Cost of equity 15%. Dividend per share, here I'll call it as D1 and here 0, dividend not paid. Dividend per share, D1 and 0. If you pay dividend, the dividend is D1. If you're not paying, it is 0. dividend paid D1, dividend not paid 0, not paid 0, closing price, that is P1. If you remember, P1 is equal to P0 into 1 plus cost of equity minus dividend, 1 plus cost of equity minus dividend, that is 10 rupees will go up by 15%, 11.5. Then if any dividend is paid, 10 into 1 plus 15% is 11.5. So here price will be 11.5 minus D1, and here it's going to be 11.5. Dividend is not there. Dividend is not there, not paid scenario. Dividend is not there in the not paid scenario. This is on the price analysis. We normally used to do the price analysis first. So we have done the price analysis. The closing price will be 11.5 minus D1 and 11.5 depending on whether you're paying dividends and not paying dividend. Total earnings less dividend, retained earnings. Total earnings less dividend, retained earnings. Total earnings given in the question is 5 lakhs. 5 lakhs. As of now, there are 2 lakh shares in the company. There are 2 lakh shares outstanding. So dividend paid is 2 lakh D1. Dividend paid is 2 lakh D1. Dividend paid is 2 lakh D1. This side no dividend paid. So retained is 5 lakh minus 2 lakh D1. And here retained is 5 lakhs. Retained is 5 lakhs. So first we find out the closing price. Second, we do some analysis on the retained earnings. This would be compared with the investment. So investment I1. Investment is I1. I don't know the amount of investment. Let me call it as I1. Investment is I1. Amount raised by shares, that is amount raised through issue of shares, is I1, which is the investment, minus 5 lakh minus 2 lakh D1. Investment minus retained earnings. Investment minus the retained earnings has to be raised in the form of fresh issue of equity shares. And beyond this, we can do it outside the table itself. Amount raised by shares is I1 minus 5 lakh plus 2 lakh D1. And other side is I1 minus 5 lakh. Other side is I1 minus 5 lakhs. Okay, let's first look at dividend not paid scenario. Dividend not paid scenario. Amount raised is equal to number of shares into issue price. Number of shares into issue price. What is the amount raised is I1 minus 5 lakhs. Number of shares is 47,619 and the closing price was 11.5. Closing price was 11.5. So let's simplify this. I1 minus 5 lakhs is equal to 547,619. Investment is equal to 10,47,619. The investment figure will remain same in both the situation. Basically, if you are not issuing any dividends, then your number of shares which you have issued. Okay, sorry, one error here. Sorry, friends. Make this 26,089. Sorry about it.
because number of shares issued is 26089 if no dividend is paid. Sorry about it 26089. So 26089. In case I make any errors, please do highlight them. 3,24,000. Approximately I can say investment is 8 lakh. 8,24,000 I get, but approximately it's 8 lakh. Let us leave it as 8,24,000 itself. Let's leave this at 8,24,000. The investment which is happening is 8,24,000. Number of shares issued is 26,089, not 47,619. That's an error from my side. 26089 into 11.5, 3,24,000. I1, which is the investment made, is 8,24,000. This is helping me in getting to know the investment made. Whatever calculation we did was when dividend is not paid. Please note this. If there are doubts, please let me know. Any doubts, please let me know. 8,24,000. 8,24,000. Any doubts on this, please let me know. Then comes again amount raised is equal to, I hope you have noted it. Anyone still writing, please let me know. Amount raised is equal to number of shares into closing price. It is I1, I'll write the figure for this, minus 5 lakh plus 2 lakh D1 is equal to 47,619 into 11.5 minus D1. 11.5 minus D1. I1 figure was 8 lakh. 8,24,000 minus 5 lakhs plus 2 lakh D1. Write along with me. It's a reverse working question. 8,24,000 minus 5 lakh plus 2 lakh D1 plus 2 lakh D1. 47,619 into 11.5. 547,619 minus 47,619 D1. 47,619 D1. Some rounding of gaps can come, can't help it. 47,619 into 11.5. 547,619 minus 47,619. Okay, this comes this side. I'll take the D1 this side. 247,619 D1 is equal to 547,619 plus 5 lakhs minus 8,24,000 minus 8,24,000. D1 is equal to 247,595. Broadly, I think it will be 1 rupee. 247,595 divided by 247,619. Yeah, 0.999 rounded off to 1 rupee. So the dividend which is going to be paid is 1 rupee per share. I'll repeat again. Amount raised is equal to number of shares into the closing price. What we normally do is number of shares is equal to amount raised divided by closing price. So amount raised is number of shares into closing price. I1 minus 5 lakh plus 2 lakh D1 is equal to 47,619 into 11.5 minus D1. I1 is substituted as 8,24,000 minus 5 lakh plus 2 lakh D1. Other side you do a multiplication. Net you get dividend as 1 rupee per share. Dividend is 1 rupee per share.
and the investment is broadly 8 lakh rupees. Not sure if ICI has done rounding off. Let's check what they have given. 8 lakh 24, dividend 1 rupee. Dividend is 1 rupee and 8 lakh 24 is the investment made. If there are doubts, please let me know, else I end this question. Any doubts, please let me know. Okay, we end this now then. Hi friends, so let's cover the additional question in your chapter 10, which is on management of working capital. Balance sheet of X Limited for the year ended 31st March 2022 is given below. Equity shares, retained earnings, debentures, public deposits, trade creditors, bills payable, and assets is fixed asset, raw material, WIP, FG, debtors, cash and bank. Calculate the amount of MPBF, maximum permissible bank finance, under 3 methods as per Tandem Committee lending norms. Total core current asset can be assumed as 30 lakhs. Go through this. Go through the question. So very simple question on your Tandem Committee norms. Like a formula driven. This is more of a formula driven part. Go through the question. Okay, so what your Tandem Committee said is there are 3 methods and each of them was working with a current ratio target. Basically, your current ratio should be closer to 1.33 and that is how those formulas were devised. So method 1, MPBF is equal to 75% of current assets minus 75% of current liabilities. Method 1, 75% of current assets minus 75% of current liabilities. 75% of current liabilities. Your 75% of current assets is this plus this plus this plus this plus this, except fixed asset. Except fixed asset, we'll consider everything. So 75% of 480 lakhs. 75% of 480 lakh, ignoring the fixed asset component. And this side you have bills payable, trade creditors, and public deposit. Bills payable, trade creditors, and public deposit. These are the 3 items which will come. These are your current liabilities. Minus 75% of 280 lakhs. 75% of 480 minus 280. Net it will be 480 into 75%. 280 into 75%. So 360 minus 210, rupees 150 lakhs. Rupees 150 lakhs is the method 1 answer. 75% of current assets minus 75% of current liability. Method 2, MPBF is maximum permissible bank finance. 75% of current assets minus 100% of current liability. So basically the logic is the bank will fund you 75% of current assets. So that is the funding which you can get, but eliminate everything of your current liability. Eliminate entire current liability which you currently have. So 75% of 480 lakhs minus 280 lakhs minus 280 lakhs, rupees 80 lakhs. So method 1 will give a higher amount, method 2 will give a lower amount, method 3 will give the lowest amount. So 150 lakhs as per method 1, 80 lakhs as per method 2. Method 3 said MPBFS 75% of non-core current assets.
non-core current asset minus 100% of current liabilities, minus 100% of current liabilities, 75% of non-core is from 480. Remove the core. Core is something which the promoters have to bring from their pocket. These are essential current asset which the promoters will have to fund. Bank will fund only the non-core, so which is 450 lakhs. 30 lakhs is core current asset. I removed that. Minus 280 lakhs. Minus 280 lakhs. 337.5 minus 280. 337 minus 280, 57.5 lakhs. Now, logically speaking, which method the banks will adopt depend on the industry, depend on other parameters. But the three methods give an answer of 150, 80 and 57.5. Under the three methods, they wanted the maximum permissible 150, 80 and 57.5. An extremely simple question, but yeah, unless you remember the three methods formula or the logic. Logic is 75% of current asset minus 75% of current liability. Balance 25 promoters will have to bring. Second method says balance 25 promoters will bring in, but we will subtract 100% of current liability. Method 3 says promoter has to bring in core current asset. We will fund only the non-core current asset, and there also will subtract 100% of current liability. I end this question now.